Greetings, traders. It is I, Abdul Shabazz. This is Some Real Change Stock Options Trading Journey. And today, this terrific Tuesday, August the 25th. Getting the charts together right now before I create my plan. Getting my plan together real quick. Straightening out my charts, seeing what's what. As you know, I had an alarm yesterday at the 767 area. I was only interested in a call if we got above that 767 area. So same thing comes into today. My alarm is still intact. I want to see us break that 767, establish support there. Bismillah. Then I'll potentially be interested. But I'm not interested. I'm not interested in anything in between. So my plan for yesterday is still going to be my plan for today. Take a 767 call. Get in around 768 because I'm looking for a break and retest. I'm looking for us to establish an area of support in the 767. And then I could potentially go to 771, 773. That's how I feel about it. Puts, I'm not interested in any puts until we get to that 762. However, there could be a rejection play where you might be able to take it back to the 762. So that could be a potential play as well. Especially if we got, I would say, back below the 765. You could take that down to the 762. Possibly. Make another set of plans. So as I was saying, the 765 and take that back down to the 762. 765, 6 area. Nothing is exact. We're just talking areas. 762, 3. Just leave my options open and available. So I'm gonna go ahead and put my alarms, in place. Well, they still are. I got the 765 for the break and retest for a call. Gap up. She would come back down. You got to be aware of her trying to just simply fill the gap as well. Might not necessarily be a move down or just a possible fill the gap. Who knows? But I will be looking for my setup off the larger time frame. That I do know. So I'm going to be patient. Even as we look at the 30-minute chart, she's already up here at the 766 area right now. So there's really no decisiveness because she's gapped up to this area. So be aware of the, the gap fill back to the 765, and then she could potentially bounce. It's just a mess right now, for real, for real. It's just a choppy mess. There's no real decisiveness. It's really indecisiveness right now, indecision, which right now going on in the market. A lot of choppiness, just a lot of choppiness. Just is what it is. I'm gonna be patient. I'm gonna let the market show me the trade, let the trade present itself. It's gonna have to be out of my playbook in order for me to deal with it. On trade before 10, allow the charts to form. Identify who's in control of the overall market. Look at the trend for the week and then the trend for the day. Well, for the week, now we are in Tuesday, we are red for the week. And for the day, we have another consecutive red day. Red for the week, red for the days. I want to identify the possible trading areas on the chart. For me, those trading areas are identified above 767, establishing an area of support, and more so below 762. There is a potential scalp possibly below 765. We'll leave it at that. Set alarms near those areas. Okay, that's exactly what I've done. Now wait. Identify the next support or resistance level. These would be my profit taking areas. I've done so as that as well with identifying where I would like to take a profit. So if I do take that call, I'm looking to get out at 771. Second profit target area is going to be 773. If I do take that scalp with that 765 break, then I'm only looking at scalp to the 762. So I have identified my profit taking areas as well. All right, after I identify that, then I go to my rules before entering a trade. State out loud what setup you see. It needs to be on the 15-minute or the 5-minute. Okay, I'm sorry, the 15-minute or the 30-minute. The 5-minute is for entering the trade. It needs to be on the 15 or the 30-minute. The setup. Change that here. Setup. Setup needs 15-minute or 30-minute. Period. 5 is for entering. 5 minute. The 5 minute. It's for entry. Okay. All right. The setup needs to be on the 15-minute or the 30-minute chart. The 5-minute is for entry. We do not look for any setups on the 5-minute chart. Everything out of my playbook comes off the 15 or the 30-minute chart. And I have matured to that. And that's where I'm at now. No more setups off the 5. The 5 is strictly for entering the trade. State out loud whether it's a scalp or a trend trade. If it's a scalp, use an in the money 0 DTE. And if it's a trend trade, use it at the money next day expiration. You don't need to be bold. Okay. Select the appropriate bracket order based on risk and reward. My bracket orders I set up 3 to 1. What are they? 2 to 1, 3 to 1, and 5 to 1. Select the appropriate bracket order based upon your risk and reward. Okay. This does not need to be here. Enter the trade as per the rules for the setup. You are trading. Use the 2 entry method on the minute as average. No, I'm not doing that. Because we go to 0. Adjust your bracket order to the appropriate area. For profit. What the heck just happened? Put him down. I'm on air, yo.
He usually doesn't meow when I pick him up.
He was fine till you walked in. Go on doing what you're doing. Get me on the TV like I told you. Shut up, boy.
Hey, turn your mic off if you're going to be fussing. Nobody wants to hear that. And it's embarrassing.
Appropriate area for you to take profit. Now let it. Okay. Because I now trade to 0. I don't believe in this anymore. I only focus on my take profit, my stop loss area. For me, I'm going to tell that to the team and the team setting. Hey, everybody, pop back up on my feed this morning. I got back a couple months ago and the room was closed. Trader Rex. Glad you back, Trader Rex. We weren't closed, Trader Rex. I was I wouldn't say on vacation, but I was in the middle of the ocean. That's for sure. I was out there doing some fishing. My other job is a commercial fisherman. If you ever seen the TV show Deadliest Catch, that's what I do. I was out to sea, putting my life on the line. Have no fear. I am back here, simply just ready to put my money on the line. Glad to pop back on your feed. Glad you subscribed. Shout out to you, Rex. I do appreciate you. Trader Rex in the building, y'all. Trader Rex. Going over my checklist. And here we go once again, top to bottom. Don't trade before 10. Allow the charts to form. Identify who's in control of the overall market. Look at the trend for the week and the trend for the day. Identify the possible trading areas on the chart. They're going to be stop out areas and profit taking areas for both bulls and bears. Set alarm near those areas. Wait now and identify the next support and resistance levels, because either one in either direction will be where I want to take profit at, not in between. We want to take profit at levels, not in between. Rules before I enter a trade. State out loud what trading setup I see. The setup has to be on the 15-minute or the 30-minute chart. The 5-minute is just for entry. If the trade that I'm taking is not from my playbook, you're gambling. State out loud whether it's a scalp or a trend trade. If it is a scalp, we're going to use it in the money, 0 DTE. If it is a trend trade, we're going to use it at the money, next day expiration. After that, we're going to select the appropriate bracket orders. That's right. A bracket order to take you out if it goes against you, and a bracket order to secure your profits if it should reach your level. Enter the trade as per the rules for that setup. For that trade setup that you're trading, into the rules for that setup you're trading. Adjust your bracket orders to the appropriate area. Make sure your bracket order is at the appropriate area for your take profit. I did not say stop loss. I said take profit. Why? Because we're trading for 0. I'm letting it go to 0. I'm no longer going to allow myself to be wiggled out of a trade and then have it turn around and go in my favor. So I will be looking at how much money I'm spending on the contracts, and whatever I feel comfortable risking for the day, that is how many contracts I will buy, and then I will allow it to go to 0 before I stop out. No more risking $1,000 or putting $1,000 into a trade, but I'm only going to risk 500 of that 1,000 on the trade. Well, if that's the case, just get $500 worth of contracts on that trade and risk it to 0. That is what I will be doing, and I will not repeat that again for free. My plan for today, look for a call. If that 767 can hold, probably get in around 768 with a break and retest, catch it on the way back up if that happens. If it doesn't happen, there could be a potential short below that 765 area. That is where I potentially might look to get in on a break and retest of that 765, turning that support into resistance. And if that happens, you'll see this go from green to red. The support line will turn red if the market is able to break it and then continue its way down. Hopefully, guys, I have a drawing tool on the way. I asked my assistant to get me the drawing tool that'll help me better diagram the charts. I haven't heard anything. Hopefully, I'll be surprised. Bismillah. And of course, the greater put is if we get below 762. Anything can happen. Alarms is set. I'm not going to babysit it. I'm going to let it do what it does. And I'm going to do what I do best. Pick and shoot. in Kosi. Oh, Trader Rex is in Kosi. Yes, sir. It's in Kosi in the building. Yes, sir. I tell you what, man. There are so many people trading now. It's crazy. It's crazy. So, with me, it's all about who gonna last. You know, who's gonna last. And you know, I'm in it to win it. I definitely ain't going nowhere. I spoke yesterday. Matter of fact, can you bring me my phone so I can read that message from my $1 million friend, my millionaire trader friend who just texted me? I definitely ain't going nowhere.
I don't know where it's at.
It's on that table over there. Read this message from my millionaire trader friend. Walillah alhamd. Oh. Wow. Wow. I can't even share it. Yeah. Wow. Just wow. Yeah, I ain't going nowhere. I'm here. I'm here. Too much good we need to do here and around the world beyond our reach. Too much good. We're going to get rich or die trying. Yes, sir. Quiet souls in the building. What's up, some real change family? Let's get it. Man, I'm hoping the market gives us an opportunity to get it today. Looking at a call above the 767 area. Seeing if we can turn that to an area of support. If we do, I might be looking to join them in a call. If not, looking at that 765 area for potential scalp just back to the 762.4. We'll see. Be referring to the larger time frame. Market's been choppy. Just look at these last couple days. Small body red candle, doji. Mid-size red body candle, but with a big wick up top. Okay. Another doji. Yesterday, a very deformed looking hangman. But today we've gapped up. So we got to watch out for the gap fill and then see what happens. Either way, man, I'm glad the team is back here. That's for sure. Definitely going to be looking at the larger time frames. It's just a mess for real. Still showing you my trading view plans from yesterday. Same thing is really in effect today. What the heck is going on with that? All right, here we go. Okay. I drew this. I drew this yesterday. I'm not gonna move the the arrows because it's still pretty much the same. I want to see us break out of this box that I drew, okay, with some support above that 767 area, 767 area, turning that to an area of support, and then I would like to join a call to take that up towards the 7732, and that's what you see in my plans here, up to the 7732. Now, if we do come back down, there could be a play from the 765 back down to the 762. The bigger play is below the 762, and I have that as well. The bigger play is below the 762, but there could be a scalp at that 765 area. Why am I saying that? Because we saw that yesterday twice. Hit that 765 area, come on back down to 762.3. Again yesterday, 765 area, flushed back down to the 762. So it could happen again today. But either way, I'm gonna give this market some time to reveal what it wants to do, and then we'll pick it apart piece by piece, inshallah. If anybody has any plans or they would like to share, feel free. Put them on the chart. I got the SRC phone. If anybody wants to get on air, you can. I'm actually going to put the number up now. Make sure it's working first. Let me make sure it's working first. It's not staying on. I think it needs to be charged up again. Gracias, señorita. phone is not charged, but we'll get to it. I'm looking at a break and retest of pre-market high, long or pre-market or previous day high, going short. What's the previous day high? That's that 765. Same thing I'm looking at in Kosi. Same thing, buddy. Aaron Smalls in the building. Yes, sir. The team is here. He said, looking for a break of pre-market high. I'm looking at the same thing. A break and retest and an establishment of support at that level. So we both have the same idea. So that is reassuring. We both have the same idea. Now let's just see what the market does. We're not in control of what the market does. We're only in control of what we do. And we will maintain discipline until we see an obvious trade. Keep in mind there has been a little bit of rhetoric talk about Nvidia's earning that is coming out tonight. If anybody knows anything about it and wants to share, let me know. Cutting on my co-host right now.
Industry, supply chains, and across the retail marketplace led us to an increasingly aggressive promotional environment, or led to an increasingly aggressive promotional environment. And in response to these changes, we felt it was important to remain competitively priced to protect our leadership position. What does that mean? It means they had to cut price on a lot of things. It means they've lowered their Foot Locker business pro forma comparable store sales outlook to a range that is now -2% to a high of being flat 0%. And they therefore also lowered their operating income outlook for both Dick's and the Foot Locker business. Jim, so far not going that well in terms of this acquisition.
All right, if we go ahead and interrupt these guys just so we can take a look at the bigger picture. I have the 15-minute chart pulled up. Consumer confidence and new home sales at 10 o'clock. Thank you, teammate. He said at 10 o'clock we got a report coming out, and that report is going to be consumer confidence and new home sales. As we back up the 15-minute chart, you can clearly see the chop that I have been talking about here. And you can clearly see why I want to avoid this non-trading zone that I have drew here on my trading view. On my Thinkorswim platform, you can clearly see, let me go ahead and highlight this. Préférez-voir, s'il vous plaît. From where my alarm is at the 765 to where my other alarm is at the 762, you can clearly see my alarm. I want to trade outside of this box. This is the same box on my trading view chart that I shared with you all. This is it here now on the Thinkorswim, just highlighted. Okay? Anything in this box is very simple. And as I stated before, that break below the 765, that potential scalp, back to the 762. Okay, we did it here. We did it here, even though it was overnight, but it went into the very next morning. The very first candle went from 764 all the way down to 762. Okay? So that's why I said there is a potential scalp at the 765, back to the 762, because it has happened twice. There is a ceiling at 767. Hit once, hit twice, hit 3 times later. There's a ceiling here. So until we can break this and turn this ceiling into a floor, I'm not interested in taking a call. Because even if you take a call above that 767 area, if we look just a little bit more to the left, as I pull in some more, you can see there's clear overhead resistance above. There is clear overhead resistance all the way up. So you can't feel comfortable about a call. I don't feel comfortable about a call. I really rather take the put. But it doesn't matter because we're going to make our money up, down, sideways, whichever way the market wants to present an opportunity. But we have to see the opportunity that presents itself. And if we just look, because we're looking at the larger time frame, we've got time. The market's not doing anything. If we go back to last Tuesday, just to start with, because that's how far this chart going back. Nothing burger, nothing burger, nothing burger. Wednesday, there was a short scalp opportunity, okay, with this 3-candle reversal right here Wednesday that took place at 11:15. You could have taken that all the way to 11:30, or you could have gotten this lower high, okay, with this almost engulfing, bearish engulfing candle. You could have waited for the confirmation here at 12:30, got in at 12:45 candle, and drizzled your way out. That's all that was available there. Thursday, nothing burger, nothing burger, nothing burger. Okay, until you got to this beautiful 3-candle reversal after an established lower high. Okay, this came at 1 o'clock. Beautiful opportunity, breaking at 765, taking it back down to the 762. Friday, nothing burger until 12 o'clock. Beautiful 3-candle reversal. You could have stayed in that back to the 765 area as well. Yesterday, nothing burger, nothing burger, nothing burger. Slight opportunity here after this shooting star, but we had a failed shooting star, which is a bullish sign. And then, but if you would have entered after that on the continuation, you'd have got freaked out on the following candle. But if you'd have traded to zero, you'd have been all right. But it still was a nothing burger. So again, there's some short scalps in here. Some short scalps, but not enough for everyone to make money off of. Only those people who can identify them and take advantage of those shots extremely quickly. But for the majority, we wanted that easy money. That easy money is below 762. That easy money might be a break and retest of the drop below 765, turning this green area of support into a red area of resistance. If that doesn't happen, you have nothing. Go find something else to do for the day. Set your alarm, do something else. Pulling up the 30-minute chart. Again, that is my adjustment teammates. All my playbook setups now come off the 15-minute or the 30-minute. The 5-minute chart I only use for entering the trade. I do not take any setups off the 5-minute chart anymore, because by me taking my setup off the 15-minute chart, off the 30-minute chart, that's just ensuring I'm going to get at least a 15-minute run or a 30-minute run instead of cutting myself short. Even when I enter the trade, I'm only looking at the quarter marks, 10 o'clock, 10:15, 10:30, nothing in between. I want to let that candle close, see what the candle does when it closes. Referring to the higher time frame, you got to let it close on the quarter, the 15, the 30, the 45, the hour. Well, those are the latest adjustments that you will be seeing in my trading here upon my return. Those are some of the latest adjustments. back to my co-host.
that they have helped sort of that groundswell,
Jesus,
which
you're
would be
kidding me.
genius if it were the case. Doesn't mean it doesn't exist and it isn't there. And by the way, it's more than just a concern about water or land use or electricity. Carl,
They've solved every one of those
Elon Musk
problems.
is reported to have said on a recent call involving the closing of the Cursor acquisition, and he said something similar in that.
$4
In that,
billion
let me
ARR.
just finish.
$4 billion
In that
ARR.
discussion with SpaceX employees last week, where he said it's inevitable AI models will become so advanced they'll be impossible for humans to control. I mean, I know how you know how I think about
Well,
this.
damn.
Yes.
But I'm not sure if that makes me feel good about data centers.
Well, that's not the point. The
Take a
point
listen.
is-
You want to take a listen to my friend Elon talking
Yeah,
about that?
all right, sure.
Thank
He's
you.
He's a positive fellow.
We must win on AI because the future is overwhelmingly AI and robots. So we won't ultimately be able to control the AI. It'll be too smart for that. But just like if you have a child that is a super genius child, you can still instill in that child the values and beliefs that you think are good and right. And so that's why it's incredibly important that we succeed with Grok.
He's been saying
I
the
was on
same
Grok
thing
today,
now
man.
for a bit of time.
I was on Grok today. It's pretty damn cool. Grok is cool. I'm coming. You know, I'm using the Grok.
Using the Grok now.
Grok is really good for being able to build a
You're using the
dashboard
Claude
for.
too.
Yeah, well, I use these.
How about the chat? Using the chat?
I use
the
chat
Gemini even?
Yeah, last night there was I asked for the breakdown of buybacks and dividends, S&P 500, and I got two different answers from ChatGPT by answer. But the problem
Yes,
is-
sir.
And I got a different answer from Claude, and I had to scrap it entirely. and just wrote,
I just got to
"There's
put a
lot
date
of
on it now.
Because Ben Stoto caught me. But
I just gotta put a date on it, Quad, so,
Where'd you get it? I said I got it
so
from
I will
ChatGPT
do
and
that,
Claude. I did
especially-
both of
That's
them.
never good.
And,
Might as well just start at the
and-
beginning of the
and
month.
They were all wrong. They were all wrong. So it's no.
me
If
see.
they're going to take over, they better be smart. But I guess they are going to get
This is
smarter.
25th,
and I come back and
next
say,
Tuesday.
hey, they're going to knock over China's government.
start
knock
next
over
week.
ours because that's how far ahead.
Start next
China
week,
is.
God willing. Thank you, buddy.
It's gonna be China.
I needed
Follow
that.
the
China's really ahead
I
of us.
needed that. Thank
And
you.
No,
Chinese-
they're not ahead of us. They're not ahead of us in the development
I'm
of the
now
models.
reading that they're 17.
They're not ahead of
they're
us in the
17
development of the
They're
models.
17 days behind us. I read. Actually, I read that. 17 days.
Great. All right.
Is that what Claude told you?
17
No,
days?
that was-
Not 18,
that
not
was
16?
That was perplexity.
They're
No,
gaining
not
on
really.
us. I don't know how far ahead we are, but our models are more sophisticated. They have
now.
more access to power, maybe even more access over, but not
But-
to necessarily the highest end chips as we know. So
Look,
and they
I'm
got a
not-
lot of data
I'm not
scientists
disagreeing
and
with
computer
you. I'm not
scientists.
disagreeing.
Thank
with
you, bro.
man.
Me
I
too,
don't know.
man.
I just know
It's
what I
all
read.
fun.
I
I'm
haven't
looking
been
forward
over
to it as
China.
well.
I would love us
It's gonna
to
be
go to
awesome.
China. I'd love us to do a nice little tour of the
I'd
entire
love to
country.
do it too, because I come in peace. I'm like 10 bears.
I'm sure they'd open everything up to us and let us really see the innards of
Like
it.
they do with Eunice. Hey, maybe they'd even be a kind of a chaperone.
I'd like to see those robots, one of which ran faster than
Did you see
Usain
the Robot
Bolt.
Olympics?
That would be interesting, although if we really want to
I
do
saw
this
that too. Did
operation-
anybody see that? China has a robot that ran the 100-yard dash in a 9.7 something, faster than Usain Bolt. Unbelievable.
The guys who sang Hey Ya?
You bet. And they're in the Hall of Fame, so let's not knock them. Outcast, Upright Outcast, Outkast, because that's about as serious, right? Lend me some sugar. I am your neighbor.
I am your neighbor.
That's what we're doing. We're lending some sugar instead of oil. I'm not kidding. I mean, come on. China's not going to play ball. Isn't that who no, it's actually.
No, and they made it
Turkey.
clear they're not
It's
going to-
Turkey.
they're
Like,
not going
Turkey's
to
gonna
play ball.
It's Turkey's going to play ball. Turkey hasn't played ball since they became. Well, they got in NATO for nothing, right? What do they like? Put them in? What do they do? You know what I mean? Turkey.
I'm aware of Turkey.
What leverage do we have over Turkey? Tell me. What leverage?
Hey, I'm about to
Would
show
you
it to you
rather
now,
have a
guys.
country over
Watch
Turkey?
this.
Are we gonna block our?
This is this Chinese robot 2 days ago that beat Usain Bolt's record. Okay, here we go. Now you can see it again now. It's over. Did you see what he tried to do? Yeah. Unbelievable. It's the end of the world as we know it. Elon Musk just said, we will not be able to control AI. The best we can do is program it to be good, so it makes good choices and decisions. What? All right, team, I got my alarm set, man. I'm going to go ahead and dip out of here. I'm not going to sit up here and babysit this. I'm going to let it, and hopefully we'll get an opportunity to trade. I'll share with you what my plans are, where I'm trying to trade, why I think this way. The floor is open. If anybody has any other ideas or sees anything different, wants to share it with the team. Other than that, be careful, because there are a lot of people just, looking to trade today. So yeah, that could be that potential scalp at that 765, but the first time it might be a trick. So be aware of that, so you don't get caught up in that trickery and that buffoonery. I'm gonna just highlight this to the 762. No need to go below that right now. So we have yesterday's action and today's action on the 15-minute chart. We got the last two days action on the 30-minute chart. Top right daily, bottom right is the weekly. We are green for the week right now. Just what it is, what it is. Right now it's nothing burger. I'm cool with that. I'll get back with y'all in a moment.
Pretty good day for the chips. Marvell's up 7, but AMD's up about 5 as Ray J goes to strong buy from Outperform. They go to 641. A lot of this, Jim, is about CPU demand. They think they can overtake Intel next year.
Right, and I think that Intel's been losing share forever, but for a very long time, previous bad management. But give Lip-Bu a chance. He's doing a lot of different things. Right. I don't think you sell Intel, and I do think you can buy AMD. I think Lisa Su's amazing.
Yeah. Have lost the opening gains. Dow's gone flat.
Yeah.
We'll get Stop Trading with Jim next. Let's get to Jim and stop trading.
Well, there's some curious things here. There's a tweet by Elon Musk yesterday. I'm going to post, I'm sorry. Partnering with NVIDIA has designed a space-optimized Vera Rubin. And here, NVIDIA puts out a note saying that computing into space, well, it's happening. Remember, a lot of people were laughing about data centers in space. Musk comes back and says that it's going to be in significant scale in 2028 and fourth quarter next year when we'll start seeing it. Now, a lot of people have been saying, come on, this is another one of these fanciful, we're all going to be in, I don't know, self-driving buses. But I would say that you may think that Musk is puffery, but Jensen is not puffery. And so I think that this is one of those things really to watch. I really think space.
Yeah, no,
it's here.
orbital compute in late 27 is a huge story.
Yeah, and now this does not need to be. You're not going to get. There's no locality that will be mad about this. No one in space is going to talk about electricity. No one in space is going to talk about water. No one's going to talk about power because the sun is the best.
Yeah, it's just about oxygen and radiation.
I just think that, well, those are true. But I do think that this is brilliant. And
we did get Falcon this morning. Did you see it cross over Brooklyn?
No, I didn't. I just watched the video.
No. Oh, my gosh. It was a crazy video this morning.
I got to tell you.
Went over D.C., New York City.
It's going to happen, so stop it. It's going to happen.
Nobody told me.
Stop laughing at
stuff. I'm not laughing at you.
It's going to be up there. And it's not that.
What did you just say about the sun? The sun is the best. I think you said that.
I don't know if that's the sun.
The sun is the best.
That's the kind of insight we love. The sun is the best.
I love it because the son's name is Saul. All right.
Yes, Spanish.
We'll see you tonight. By the way, into it at 6.
Into it tonight. I mean, it's down 8. I mean, it's been like one of those that you're supposed to be able to get Claude to do your taxes. Let's see how many people use Claude for their taxes. Yeah, with like the numbers that I've been getting. Oh man.
Mad Money, 6 p.m. Eastern Time. We'll get some new homes in Conference Board after the break.
I'm here, team. I'm here. Gotta let the candle close. Gotta let it close.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Picker, David Faber here at Post 9 of the New York Stock Exchange. Sarah Eisen's off today. Stocks moderately higher this morning. Oil is lower as investors monitor some developments in Iran after yesterday's sanctions news. We'll get you the latest this morning. As pushback grows against data centers, we'll talk with JP Morgan's head of AI infrastructure investment banking about how he's weighing investments amid some political backlash. And the CEO of logistics company RXO is with us as a number of names in the shipping and freight world see some big moves this week after the escalating trade war with Canada.
First, though, we got some new economic data just crossing. Rick Santelli has that for us. Rick.
Yes, good morning, David. Conference Board Consumer Confidence month of August. Expecting a headline number slightly over 90, a miss here, 89.4, and this follows a slightly revised 90.2. So less than expectations, sequentially, obviously less than our last look. 89.4 would be the least since January, 89.0, second weakest of the year. Present situation, well, this is the bright spot. 121.2, significantly higher than expectations, significantly higher than a slight revision of 114.4 in the rearview mirror, and that would be the best overall performance since April, where over 124. And finally, on expectations or what lies ahead, this one, very similar to the headline, comes in deficient, 68.2, looking for a number over 74. 68.2 would be the lightest going back to, wow, you have to go back a ways. 68.2 would be the lightest since January when it was 67.2, so second weakest of the year, sequentially lower than 74.0. And very quickly, Richmond Fed for August comes in light at 4. And if we look at the business side or the service
I'm in the
side,
trade,
well
team.
under expectations at minus 12.
I repeat, I'm in the trade.
Weakest level of the year going all the way back to November, but manufacturing being positive just adds another positive anecdotal brick into the wall of recovery in manufacturing.
I'm using the 766 area as my stop out area. If the market should get back above 766 and hold, this can also show a reverse in what is actually happening now and possibly retake the day. Going from red to green on the day is where my stop will be if we go from red to green on the day. I was looking for this break of the 765 area and then having the ability to turn this area of support into an area of resistance and then taking that down to the 762. So this is the scalp trade that I called out. We're probably going to have a little bit of resistance here at the 765 as we come upon the 200-day moving average. But right now, I wish I'd have got in just a little earlier, but I wanted to see us turn this area into an area of resistance, and it's still not over yet. Okay. I'm not going to sit up here and babysit it.
So essentially, Bessent fired a warning shot here. Beijing then fired one right back. And for President Trump and for this administration, they're a little bit hamstrung here. There's a massive trade relationship at stake between the U.S. and China, and Beijing could inflict real economic pain on the U.S. if it moved to hike tariffs or to cut off the critical mineral supply, just to name two examples. President Trump has also been very focused on maintaining a strong relationship with President Xi and making Xi's visit to the White House, planned for next month, a success. But all of that said, China bought about 90% of Iran's oil before the war, so it's really difficult to choke off funding to Iran without truly targeting Beijing. Guys?
Which we're not doing, I guess, is fair to say. Correct? Is that the conclusion at this point?
At this point, at least not yet. I mean, Bessent was clear, no one's above these sanctions. He said Chinese banks would be targeted if they were found to be facilitating Iran's oil sales and any of that, but he's not doing it. And the question is still out there of just how far the U.S. is willing to go to actually crack down on China. Bessent talked about talking with other countries, saying there were timelines in place, there were going to be deadlines, but he wouldn't give specifics. China also, when CNBC asked in Beijing today, wouldn't give specifics on any timeline or deadline they've gotten from the Trump administration. So it leaves it in limbo, and it suggests that the Trump administration, at least for now, is holding back on taking that firmer next step.
Megan, thank you. Megan Casello. Let's talk a bit about the markets here with Partners Group Chief Investment Strategist Anastasia Amorosa. Good to have you here at Post 9.
Good to see you, David.
One day the market seems a bit negative on the overall AI ecosystem, particularly the chip stocks, data center opposition, and then the next day we start to see a bit of a rebound. I don't know. Give me a little bit of a longer term take here.
Right. Well, the longer term take, actually, maybe first of all, the near term take, I think the reason why the market is really struggling, or the semiconductors are struggling to perform, even though the fundamentals are so solid, is because a lot is priced in, David. If you look at the earnings revisions, for example, for semiconductor stocks, they're now forecasting 110% year-over-year earnings growth in 2027. So yes, the market knows that average selling prices will likely not peak until sometime next year, and the revenues are going to continue to be strong. But guess what? That's exactly why those stocks have rallied. That's exactly what's already in the numbers. And so, and the valuations, they have declined somewhat, but if you look at the multiple for semiconductors, I think 19 times today, which is well above the average that we saw before the launch of ChatGPT. So that's a near-term struggle. Good backdrop, but a lot is priced in. Longer term, David, I do think it's about a couple of things. It's about the commoditization, a lot of those LLMs. It's the open weight, the open source that are going to compete with all the other ones. And I think the cheapest models will find a lot of use in a lot of applications. And it's possible that those cheapest models are not going to need the most advanced chips. So that's kind of the longer term story. So that's why investors, I think, have to think about what the stack ranking is of the true beneficiaries of AI. You know, maybe near term it's semiconductors, but longer term it's what do you actually do with AI in your portfolio companies? And I think that is actually not priced in. The EBITDA uplift, the margin uplift, that is yet to be priced in.
Yeah, well, it's not priced in part because it's very hard to see at this point. I mean, we can hear some commentary from companies. We can certainly see it in different areas here and there. But I think broadly speaking, I don't know if you'd agree, it's just a bit too early to really understand fully what it's going to mean in terms of the efficiencies and therefore the margin improvement it may bring.
It's early days, but we are tracking several metrics that do give me confidence that you are starting to get their ROI in AI. You are starting to see tangible initiatives. And I'll kind of give you some industry color. I'll also give you some Partners Group color as well. And so for the industry, if you look at companies and the surveys, companies are starting to see not only cost savings, but actually revenue generation off of AI. And importantly, companies are getting $2.8 back on a dollar that they invest in AI initiatives, according to some of the large surveys. Now, I can tell you at Partners Group, we have been investing in AI initiatives for the last 4 or 5 years. It is a dedicated effort across 33 of our portfolio companies, 56 initiatives that are associated with that, dedicated human capital and also tech that is assigned to that. And we now are modeling $188 million in EBITDA uplift because of some of those AI initiatives. I'll tell you, David, a couple of years ago, that was 20 million. You know, a year ago it was probably 100 million, and today it is scaling. It's scaling fast, and I would suspect that is going to continue in the quarters and years to come.
So is that a financial services, healthcare play, or are there other sectors that fit into that?
I mean, the AI uplift in terms of EBITDA is really across sectors. I mean, yes, you have the financial services and the insurance angle. For example, one of our companies, Foundation Risk Partners, is one of the fastest growing insurance brokers in the United States, and we've been able to cut down the policy processing time by 94% because of some of the AI initiatives. At the same time, we have companies across software, across industrial sector, across infrastructure that are also seeing some of that.
Okay, team. game, this could be. Hold on, let me say something. I don't want to get on
story in the market.
This could be the retest back to the 7655 to ensure that this is an area of resistance now. So that was what I wanted to look for. And if it does happen, I am grateful. If it keeps going, I'm grateful for that too.
For public markets companies as well. So if you do have a higher rate that you have to discount at, let's say 5-year tenor or 10-year tenor, obviously that all things equal would bring the valuations down. But I will say there's a counterpoint to that, which is we are seeing in the markets broadly, and again at Partners Group portfolio companies as well, we're seeing an acceleration in our EBITDA growth, in our earnings growth. And so definitely a step up from what we saw last year, and we're expecting still solid low single digit on average growth in our portfolio companies. So that helps offset whatever drag you get from the valuation perspective from higher rates.
Any idea whether you're optimizing in terms of around the different models or starting to use some of the open source at some of these portfolio companies?
Yes, there's definitely an optimization. I'm very sympathetic to the view that, not every task needs to have the most expensive model. So absolutely, there's careful calculation going on. What is the right model for the right task at the right cost? And I think that's going to be the industry broadly. So that's why the winners in this are going to be many. And again, the true winners are going to be the ones who will figure that recipe out as what's the right model for the right time.
Anastasia, thank you.
Thank you.
Appreciate it.
Here's our roadmap for the rest of the hour. After the break, backlash against the build-out. We'll talk with JP Morgan's head of AI infrastructure investment banking about the growing political blowback against data centers.
Plus major software companies from Salesforce to CrowdStrike to Zoom getting ready for earnings in the next 48 hours. We're going to take a look at what the options market is expecting from those companies.
Later on, we'll talk to the Premier of Nova Scotia about this U.S.-Canada trade war. As we do await today Canada's tariff response, we think potentially at the top of the hour. Stay with us.
Welcome back. The AI infrastructure boom has plenty of capital. What it may be running short on is political support. From Texas to New York and Pennsylvania, lawmakers are putting new restrictions on data centers as communities raise concerns about power, water, and higher utility bills. At the same time, tech companies are pouring billions of dollars into the AI build-out. So is that backlash becoming a real financing risk? Joining us now is JP Morgan's head of AI infrastructure investment banking, Kevin Curtin. Kevin, good to see you. Thank you for being here. How is all of this political backlash factoring into the conversations around materiality, risk factors in terms of really financing this build out?
Leslie, good morning, and thank you guys so much for having me this morning. Just like any other big infrastructure project, railways, highways, toll roads, data centers require community support. And that is just one of the vectors of risk that you need to assess whenever you're doing a big infrastructure project. So whether that's community support, appropriate zoning, entitlement, having the right support from the financing markets, the right sort of contract structure, there are always a series of risks whenever you have a financing project in infrastructure, and it's up to the finance markets, banks, private credit, institutional markets to make sure that those risks are appropriately mitigated before you go and lend what is now pretty frequently multiple billions of dollars to a given build in a given market.
Is it changing the pricing at all, given that it can cause delays, given a lack of municipality support for these types of projects? So, is it changing the pricing discussions? Are people pulling out altogether, or has it just really not gotten to that point yet?
Well, look, as a banker covering the sector, I can say that, commercial dialogue between data center builders, their hyperscale tenants, the industry are always constantly evolving to serve both the return requirements of the customer, the delivery needs of the customer, and the return requirements of the data center builder, right? And so pricings can constantly evolve no matter what. I would say the pricing that we're seeing remains remarkably robust, which is what's enabling the formation of all of this capital, right? We've seen, for example, in the 144A market, which opened for data center construction just this time last year, the issuance of order of magnitude $50 billion of credit into that market. That wouldn't be possible if we didn't have an environment where risks were thoughtfully mitigated, pricing was robust and ensured appropriate return on capital, and folks wanted to continue coming back to the markets from a supply and demand perspective to make sure that all of this gets built and we continue to have the compute infrastructure that as a nation we're going to rely on going forward.
And obviously there's different types of financing to build these data centers. As you mentioned, private credit, public credit, equity as well. There is a kind of broader conversation about the concentration risk that's popping up, particularly in the debt financing world.
Yeah.
Is that something that you feel is a real risk at this point, or just something that maybe as we look into the future could become one, not just for data centers, but for the overall economy as well?
Yeah. The attractiveness of the U.S. is that we have the largest, most diversified, deepest, most robust, most dynamic capital markets of anywhere in the world. And so through my career, which started almost 15 years ago when data centers were sub 1 megawatt buildings, I've seen the financing markets grow, evolve, and adapt to make sure that infrastructure for this critical industrial revolution always gets built out. And issuers and tenants, regardless in this market, are always seeking out the most efficient, lowest cost, highest availability of capital. 10 or 15 years ago when we started and most of the data center companies were admittedly small cap public companies, we were relying on things like the traditional bank and bond markets. They look like technology companies all the same. Today, we've seen a remarkable evolution of the pools of capital that are financing this build out. There's been some Wall Street research published just in the last couple of months that sizes the total capex for data centers and the related chips going inside them to something like $5 trillion in the next 5 years, so through about 2030. The hyperscale balance sheets are going to cover about $1.5 trillion of that or so with their own operating cash flow. The remaining $3 and change trillion are going to be in the financial markets. And that'll be almost to quote the Oscar-winning movie, Everything Everywhere All at Once. It's going to be asset-backed securitizations. It's going to be collateralized mortgage-backed securities. It's going to be the 144A, broadly distributed markets. I think today we're seeing a rapid increase in the concentration of digital infrastructure risk, but based on the robust response we've seen from the capital markets for issuers like Hut 8, where JP Morgan led 2 investment-grade construction financings this year, to Meta, which has seen a remarkable growth in its issuance this year, the capital markets will always ascribe, an appropriate price, but we're not necessarily seeing any fall off in demand for this exposure, which remains among the most attractive risk rewards in the capital markets
Even with
today.
prices going up, I mean, we're over 50 billion now for a gigawatt, aren't we? Roughly.
Order of magnitude, yeah.
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 And rates are moving up,
Yep.
or at least have been. And I mean, you're talking about all these different pools of capital. I don't know. I just keep wondering: is there a point at which the returns start to look a little less positive, so to speak, given the risk?
It's all opportunity cost. How I think about my role in where I sit, which is one I feel pretty privileged to have, given everything
You're
going
at
on
the
in
middle
the
of
backdrop.
one of the greatest, revolutions we've ever seen in terms of both the technology and the capital.
I'll tell you, this is exactly the epicenter of all the challenges and opportunities that we face in the financial markets manifest in a single asset class opportunity. And so is pricing going to move around and are returns going to move around? Absolutely. In a given year, in a given quarter, we'll see issuance oscillate between highs and lows. We'll have macro events like we've seen over the last month. We'll have unique episodic issues. It's just been remarkable, the elasticity of the financial markets to appropriately price and consume this risk. When you think about the opportunity cost of this capital, when we are maybe moving 50, 75, 100 basis points in the return in the capital markets, that's seen as a large move. Relative to the returns on capital that Wall Street analysts are putting in excess of 15% unlevered for AI infrastructure, we still have a wide gap to go before I think the returns would be deemed unattractive. And what's most important about this asset class for folks to remember.
That was the retest, fam. It's exactly what we wanted to see, is that retest to the 765.5 to turn that area into resistance. Now let's get this money.
Comfort that for the vast majority of this build out, contrary to what folks may hear, we're actually just underwriting a stream of take or pay cash flows from an investment grade counterparty. And that's why this has broad market applicability.
What about, is there crowding out? Are there other projects that otherwise would get worthy attention that are not?
So it's a really good question, Carl. I think so far it has not been a question of crowding out. It's been a question of optimization. And so sitting in the seat that I do, helping clients across capital markets, JP Morgan's own balance sheet, private markets, what have you, it's been almost a marginal question. If a client were to execute in a given securitization market, maybe it's 25 basis points more efficient from a pricing perspective than an alternative market. And we're helping those issuers navigate those trade-offs day in and day out. But what we're not necessarily seeing is that, investors are reaching complete capacity, and so they just will not do future digital infrastructure. What we're doing is helping clients solve for that most efficient dollar. Now, what informs that efficiency decision is how the markets react to their capacity constraints. So if I do feel like, for example, I'm a portfolio manager and I have a lot of digital infrastructure, maybe my threshold price is slightly higher to do the next transaction, but that capital remains available at scale.
I would love to get your thoughts on what NVIDIA announced a couple weeks ago. People are joking that it's the Bank of NVIDIA now creating this financing mechanism for compute, for chips. What do you think about that, given that it sounds like you're mostly operating in kind of the investment grade, underwriting pretty secure counterparties? This is something a little different. It's largely for borrowers who couldn't otherwise tap the traditional capital markets and are finding a way to pay for chips and compute. What do you make of a chip maker doing something like this, and what do you think it means for just the system overall?
Broadly speaking, yes. The bulk of concentration activity, JP Morgan's own balance sheet, has been in these investment grade fact patterns. But in my role in investment banking, we have an opportunity to advise on every part of the balance sheet, inclusive of equity, right? And so whether that was our role as advising Lambda on its Series D, or Nscale on its Series C, CoreWeave on its IPO, we've had a remarkable front row seat and opportunity, thanks to our clients, to be able to see not just how debt capital is formed, but how equity capital is formed. And I think, without saying, anything non-public, it's very clear that the goal of that announcement was to form a very robust ecosystem for all types of offtake, relying on value creation from the AI factory. And because of the investment grade fact pattern so far to date, it's been most simple to finance that part of the balance sheet. But today, we are very encouraged to see all sorts of financial institutions taking part in all kinds of value creation opportunity around the ecosystem. It is my view that, the equity markets are very excited to view, GPUs and other emerging accelerator architecture as long duration, real capital assets, right? 18 months ago, the capital markets weren't so sure. Now, CoreWeave's most recent earnings report, they've got an A-series recontracted through 2029 at a profitable level, right? So we're seeing a lot of encouraging data points. And we think that should enable the formation even more broadly of equity capital. This announcement, obviously a landmark one, moving in that direction.
Yeah, and we'll get NVIDIA's earnings tomorrow, so hopefully we'll be able to hear a bit more on that
Quiet
front.
week, this is not. Yeah.
Exactly. Kevin, we appreciate you spending your quiet week with us.
No, of course, thank you. Really appreciate it.
Still to come this morning, how volatile oil prices in this widening trade war may be hitting the freight market. We'll talk to the CEO of one company powering that industry, that's RXO. Numbers sending Dick's Sporting Goods shares to their worst day in history, down 25%. And billionaire investor Stan Druckenmiller not mincing words in this op-ed aimed at the Treasury Department and his protege, Scott Bessent, why he says it's time to, quote, let the bond market speak. In a moment. Billionaire investor Stanley Druckenmiller taking the Treasury Department and the Treasury Secretary to task for announcing plans to increase the size of its debt buybacks. In this Journal op-ed, Druckenmiller says the fall in yields and the quick rebound after the Treasury first made the announcement last week shows the market judged the government's campaign as an attempt at price management, not liquidity management. Adding that, quote, governments defending prices against fundamentals always lose. The only variable is how much they spend before conceding. The U.S. shouldn't put itself on the wrong side of that trade, not with the most important price in the world, and not when that price is trying to say the one thing Washington needs to hear: let the bond market speak. Druckenmiller argues that at the end of the day, tackling the deficit is the only way to durably lower long-term yields. Mike Santoli's been chatting about this on camera and off all morning. What's important to know about this piece?
Well, I think what's new and notable about it is the source and not the substance, because the points that Druckenmiller is making here, we've aired in the week since. Notably, the bond market did not seem illiquid and disorderly, and therefore this didn't seem like it was a response to that. Everyone has noted the irony of Scott Bessent having worked for Soros, with Druckenmiller. They break central bankers and Treasury secretaries. They don't necessarily agree with the idea of those officials trying to sway markets. And the other piece of it is that Druckenmiller is obviously reading the bond market's message as purely a judgment on the fiscal situation. That's highly debatable. There's a lot of stuff going on. Germany does not have our fiscal situation. Their yields are going up. So it's a global move. It's part of its sticky inflation. Maybe the neutral rate's higher. Maybe we just need a bigger risk premium to account for a lot of uncertainty. And yes, structural deficits probably do wear on market sentiment. I do find it interesting, though. I
don't know what that was, team, but I just went on ahead, took my profits, and got out.
Listen, this is
it was so close to hitting my profit target.
Managing the national debt is our job. It is not the Fed's job. This is a private role for us.
What can you do?
And leave it at that, as opposed to when he came on our air and said, one, I have asymmetric information, which presumably is about issuance schedules and where it's going to go. And two is maybe is kind of about this kind of messaging and this kind of signaling that he thinks is going to be effective to jawbone the market. But he also said,
all right, buddy, thanks for coming out, man. I do appreciate you, man, so much.
He's making a judgment on fundamental value for long-term treasury. So if he hadn't...
Thanks for coming out. I do appreciate you so much, man. That was so close to my profit target. And for it to put in a tail like that, man, I don't know, but I do know that I cannot be upset with the money that I just made. It's my trade for the day. It's my winning trade for the day. I'm grateful for that. Start this Monday off with a nice winning trade. What that was. If anybody knows what that was, that little flash drop or something, if you know, let me know. I don't know what it was, so I'm just going to take my money for the day and run. I'm grateful for that. If we get below that 672, then again, I'm interested in getting back in the market for another put. But this was a scalp. And we said it would take it down to the 672.4. It came close, came down to the 673. Nothing is exact here. We're talking about the market. So nothing is exact here. Nonetheless, it is what it is. Trump made a post. Oh, thanks, man. Thank you, teammate. Thank you, teammate. And see, I knew I should have had that up too. Let me pull that back up. You just gotta have it. The doggone news. Finviz, you gotta have the news up. Trump made a post. Yeah, but I call this a scalp anyway. I call this scalp out. You know what I'm saying? Anyway. The bigger trade is going to be underneath the 762.4. So if you didn't able to, capitalize on this scalp with me, don't worry about it. It's more money to be made. You didn't miss anything. Content with that for right now. Looking back and trading this as the trade presents itself. Beautiful trade we got in it with the break it at 675.5. Okay, there was an area to get in earlier at the 766, but I told you guys that I wanted to see the break in the retest of the 765.5. We got that here. We got it here. Beautiful opportunity. I got in. My profit target was down here and stopped very, very short of it on that Trump post. But that Trump post was enough to drop and bounce the market. So that was enough for me to go ahead and get out of it. Taking the money that was available, taking the profits that was available. I traded it as best as it could be traded under the situation and circumstances. I missed this. I wasn't even at the computer when this drop happened. I missed that. It is what it is. But I'm glad I was able to get back in time enough to save this scalp. Now I'm just simply going to regroup. Aaron says he's looking for a reversal. Okay. And that wouldn't be a bad trade either. Looking for a reversal back up to the 766.7 area. Okay? 766.5 area even. So, but for me, I'm going to stay out of this again. I called the scalp, took the scalp. But for me, I'm still looking above 767 and looking below 762. My teammate Aaron said he's looking for a reversal. That could very well happen.
hit this week as the trade war with Canada heats up. Frank Holland joins us with that story. Frank.
Hey, good morning, Leslie. We are seeing somewhat of a rebound for trucking stocks after deep declines yesterday as investors reacted to President Trump saying he plans to put 50% tariffs on Canadian imports. Many of the biggest names in trucking, including J.B. Hunt and FedEx Freight, falling 4 to 5%, but many of those same names have had some big rallies so far this year, so we also could be seeing some profit taking. Tariffs have the potential to create a big spike in the cost of operating trucking fleets, with about 15% of U.S. vehicle imports. That includes truck and replacement parts coming from Canada. And many companies are in a replacement cycle as the U.S. is emerging from a freight recession. Just last week, we saw container shipping rates at a post-COVID high. Truckload rates have also kind of bounced off all-time highs in recent weeks. So again, it appears the demand and the volumes are there. The rails are one key area to watch. They're a lower cost but slower way to ship goods. We've already seen volumes going there as customers look for some relief from spiking truck rates. The real question for investors is if the tariffs will really take effect in January, and if they do, could this be a straw in the back of the camel situation for retailers, manufacturers, and other key customers who are already absorbing a 33% increase to fuel surcharges from elevated diesel prices? Carl, back over to you.
All right, Frank, thanks. Perfect segue. That's our Frank Holland. Sticking with freight and logistics, RXO released its Curve report today. It's a quarterly index on shipping costs, which found that spot trucking rates increased by more than 30% year on year, the highest since 2021. Joining us this morning to discuss, RXO CEO Drew Wilkerson's with us. Drew, welcome back. Appreciate the help today.
Thank you for having me again. It's great to be with you.
So 32.4 to be exact, and it's been inflationary for a couple of years, but I guess the question is, are we at some kind of inflection point on it?
Well, it's been inflationary for 9 consecutive quarters, but when you look at what the overall demand has done, demand by Cass Freight Index has actually been down for 15 consecutive quarters. So what you're seeing right now is a supply-driven inflection, and I've been doing this for 20 years, and this is the first time that I've seen a supply-driven inflection. Typically, it's driven by what happens on the demand side. But when you look at what all is going on right now from a regulation standpoint with English language proficiency, non-domicile drivers, the Delilah Law approaching, a lot of that has pulled out a lot of capacity. And it's been good for the industry because it's a safer industry. There's been less theft, less fraud, but it has definitely pulled out capacity, which has had a major impact on rates.
Do tariffs change the story very much?
It's something that we're watching closely for the midterm of, as we start to get closer into next year. But for us, the vast majority of our business is intra-U.S., so it's not as big of an impact on our business of what happens between the Canada-U.S. tariff situation.
There are a lot of questions out there, Drew, about what broker liability looks like following that Supreme Court ruling from May, the Montgomery ruling, which found that freight brokers can be sued under state law if they negligently hired unsafe carriers. There's a question whether that would raise insurance and legal costs. What's your view?
Yeah, one, we disagree with it. When you look at what our job is to vet the carrier extremely closely. And RXO has set the standard for what that looks like. If you think about just-in-time shipments, high cargo value shipments, that's how we built our model. It's built off of service, solutions, safety that goes out there. And so vetting our carriers is, we do far and above what the FMCSA requires us to do off of that. But when you look at the liability, we disagree with that, and we'll continue to monitor the situation as it goes forward.
I'm trying to think of what brings relief to the supply side, Drew, in the coming quarters. What's a bullish scenario you could spin on that?
I don't know that you're going to see any relief for the supply side in the short term. Like when you look at the amount of capacity that has come out, what will have to continue to happen is you're going to have to see U.S. citizens who are eager to get behind the wheel of a truck and haul freight. And so when you look at that, typically that happens whenever you see rates skyrocket, demand come back. So I think you'll have to see more on the demand side happen. And you also have to see more trucks that are being produced within the U.S.
Well, that's not constructive. I mean, what about longer term? It
is constructive for the freight industry, though. I would say it is very constructive for the freight industry. So when you look at what's happening on the transportation side with rates, with demand being down for 15 quarters, that has put a strain on profitability for transportation companies. And as you look at what's been happening in the last several quarters, you've seen the early innings of that start to recover. So I'd say it may not be constructive for the economy, but it is very constructive for what's happening in the freight industry.
Yeah, although we have had some examples last couple of weeks of, for example, rail companies whose surcharges exceeded the amount that they spent on fuel for the quarter.
Yeah, when you look at what happens on the rail, you see any time that there is rates going up or down, you see customers look to mode conversion. Rail is one of those modes that you see people try to shift to. LTL, less than truckload, is another mode that people do, and that's part of what we do. Is we take all of our data and we provide customers with solutions about what the best mode of transportation is, what the best day of the week is for them to be able to ship, so that they're getting the most efficient cost, but they're also getting something that gets them to the end consumer faster.
Right. What about the longer term idea that you could have a world in which autonomous trucking on some routes does bring the cost of shipping down? Are we 5 years out from something like that?
I don't know how far out we are, but it is coming, and it's something that we have said that was coming for the last decade. I think there's still a lot that has to be worked through on that. You have to look at different state regulations of what that could look like. You'll first see an impact on short haul freight, in my opinion. But there's a lot of trucks that are out there that have to be replaced. And when you look at what carriers are doing right now of adding to their fleet, they're not adding in bulks on the autonomous side. So I think we're farther away than we are closer. You know, is that 5 years? Is that 10 years? I'm not sure, but it is something that we do think is coming.
Really important metric to watch, especially when it comes to the economy and inflation. Drew, appreciate it as always. Hurry back.
Thank you.
Still ahead this morning, Canadian officials expected to hold a news conference in about 15 minutes, potentially responding to the U.S. tariffs. We're going to talk to the Premier of Nova Scotia, who says America has turned its back on its allies. First, though, we'll get to Dick's Sporting Goods. Investors running for the hills this morning on stock's worst day in its history, down 27. Stay with us.
Many brand name chip stocks are now well off their recent highs, and some are in so-called bear market territory. But could this semiconductor sell-off be overdone? With Nvidia set to report results tomorrow, one trader is making the case to scoop up the semis. Tune into our Market Navigator segment later on today on Power Lunch for more on that story, 2 p.m. Eastern Time.
Bold.
Welcome back. Here are three big movers we are watching. Raymond James upgrading AMD to strong buy from Outperform and raising their price target to $641 a share as they see the company overtaking Intel in the CPU market by 2027. Those shares up more than 4%. United announcing a big international expansion, adding 10 new international cities to its routes for 2027, served by newly commissioned long-haul Airbus planes. That stock up about 0.7% right now. And Dick's Sporting Goods shares are really plummeting there in their worst day on record after the company missed revenue expectations, citing a challenging footwear market. Those comments also hitting shares of sneaker players like Nike, Lululemon, and Deckers. You can kind of see the contagion effect, but 27% lower for Dick's right now. I mean, they missed on a ton of metrics relative to the street expectations, both in terms of the quarter and in terms of guidance, but clearly creating a spook effect, particularly Lululemon down 4% right now.
Yeah, well, margins come in as a result of the promotional discounts they may have to continue to take to a certain extent as a result of inventory for sneakers, essentially. So the Foot Locker deal not looking so good right now. They also reduced their overall comps for Foot Locker to -2 to 0. That's the new range as well. Speaking of retail, don't miss the CEO of Tanger Outlets. We're going to get his read on the consumer and how the consumer is holding up, plus what to expect out of a slew of software earnings according to the options market. We'll be live from Cboe in Chicago next.
Number of key software companies out with earnings in the next 48 hours. Let's get to Oliver Rennick at Cboe in Chicago, see what the options market is whispering. Hey, Oliver.
Hey, Carl, we do have some big software earnings coming up. Salesforce, Zoom, and Okta tomorrow, CrowdStrike on Wednesday. But the options market is very quiet in the sector, both the single stocks and the major ETFs. Maybe traders are preoccupied with bonds or the chip trade still, but it's a bit surprising considering several of these names are up big. In particular, security names like Okta and Crowd up 60% plus. The Hack ETF, which is up 37% on the year. And the volatility is pumped way up in these names. So the stocks are ripping and the vol is too. That's usually a recipe for action among traders who are looking for fast-moving plays with specific news items. Options traders expect Okta to swing 12% after its report tomorrow. And the stock has rallied after 4 of its last 4 earnings. In CrowdStrike, which has rallied in 3 of its last 4 reports, they're looking for a 7% move. Even Salesforce, which is down 18% this year, has rallied after 2 of its last 4 reports and has an implied move of over 7%, despite moving less than 4% on average in the last year. In fact, in each of these stocks, the implied moves are bigger than the company's average swing, which is also usually the type of thing that brings in options traders, but pretty quiet right now, Carl.
Yeah, it won't be tomorrow. That's for sure, Oliver, with PCE and NVIDIA and software. That's our Oliver Rennick. When we come back, Canadian officials slated to respond to the U.S. tariffs at the top of the hour. We'll watch for headlines and get them to you as soon as we can when Squawk on the Street continues. Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Picker here at Post 9 of the New York Stock Exchange. Sarah Eisen's off today. Canada fights back, set to retaliate against the president's latest round of tariffs. We're going to discuss with the Premier of Nova Scotia why he says Canada cannot trust or rely on the U.S. anymore.
Plus, chip stocks rebounding today. NVIDIA looking to snap its longest losing streak since 2022. BMO's chief AI officer is with us. Why she says demand signals will be the most important signal signal from NVIDIA's earnings print tomorrow.
Check out shares of Dick's Sporting Goods. This is the worst day on record for the stock as the retailer says consumers remain more cautious than expected. We're going to discuss the latest outlook for the sector with the CEO of Tanger as back-to-school shopping really starts to get into full swing now. Let's begin, though, with the escalating trade war between the U.S. and Canada. We are expecting Canada to lay out its response in a news conference that just began. For that, we're going to turn to Megan Cassella. Morning, Megan.
Good morning, Carl. That's right. So any moment now in that press conference, Canadian officials will be unveiling lists of U.S. exports to Canada that will face steep tariffs set to take effect 2 weeks from today. Now, Ottawa has already said the retaliation will be dollar for dollar, meaning hitting around $20 billion worth of U.S. goods. Some of the sectors that we expect to see tariffs include steel, dairy, farm equipment, and paper. The U.S. and Canada, guys, do almost $900 billion annually in two-way trade. So the goods caught up in this latest back and forth represent only about 5% of the relationship. So the economic impact in the short term will be real for certain industries. For the home builders, for example, Canadian lumber and concrete were both just hit with new 50% tariffs. But overall, the dispute remains fairly narrow for now. The concern is how much worse it could get, especially if the U.S. escalates further in response to today's retaliation. President Trump clearly not happy with Canada's decision to push back at all. He's posted 5 times on Truth Social so far this morning about Canada. He called it easily the most difficult and unreasonable country that he deals with, and he threatened to cut off business with Ontario. He says the U.S. is considering changing the name of Lake Ontario to Lake America. Guys, we just really haven't quite seen this before. Canada is the first country in the West to stand up to the Trump administration's tariff agenda in this way. The country is essentially on war footing because of it. They're bracing for economic fallout, but they're unwilling to accept a bad deal, and they're saying that they're bearing down for the long haul. Back over to you.
Yeah, Megan, the war of words is significant at this point in time, and you've got support from China essentially backing the moves and standing up to the U.S. Have we heard from any other allies about this decision from Canada, and do we have any suspicion as to whether they might take similar measures in the future?
Yeah, it's a really interesting question whether the EU, whether other nations across Asia will be looking at Canada as an example of something that they want to do. So far, most of those countries that we might expect to be closely aligned with Canada on this have already struck their own deals, the kind of deal that Canada just decided not to take. What they've been doing in Ottawa is striking trade deals with other countries across the globe in a way to diversify their economy and get some of the business that they're now no longer getting from the United States. So to my knowledge, we haven't heard any sort of explicit response. The EU is the one that's most interesting to me in this setting, but we do know that Canada is continuing to have negotiations with the EU, and you can imagine that those would be very well supported on both sides now, even more so than before, to try to help Canada get through this. I will say Canada definitely is feeling an economic impact because of this dispute with the U.S. These negotiations have already been ongoing since the start of President Trump's second term. They're feeling this, but the polling behind Carney's decision to stand up to President Trump is really, really high right now, in contrast to where President Trump's own approval ratings stand. So he's got a lot of support for this and a lot of reason to keep pushing.
Yeah, and apparently, according to the Journal this morning, going to provide $7.5 Canadian dollars, $1 billion Canadian dollars for targeted firms and workers there. On the question of embargoes, so much of the fiery rhetoric centers around cutting them off from the U.S., that is, from electricity or rare earths or potash. Is that something we're watching seriously?
It's something to be the most braced for. Canada is by far the largest supplier of energy, of LNG, of crude to the U.S. It's where we get most of that electricity as well. And so Canada has that card to play if they wanted to really cut us off. You're hearing some fiery language from some premiers across the country. We're not hearing that from Prime Minister Carney himself yet. He explicitly did not mention energy when he was talking about the sectors that would be hit. But I do think that's one of the reasons that this conflict is so interesting to watch, because we're seeing Canada stand up in this way, support its own industry with the support measures that you mentioned, that billions of dollars, and go the long haul on this. And that's left in their arsenal, that they could cut off the U.S. supply to these energy markets if they wanted to. That would be very damaging, even more so than just affordability measures in the U.S.
Yeah, it really feels like a new moment in this ongoing trade war. Megan, thank you for following all the details for us. Megan Cassella in D.C. Shifting to the broader markets as stocks are off the highs of the morning. Chipmakers leading the overall move higher ahead of NVIDIA's earnings call after the bell tomorrow. Ali McCartney, Managing Director, UBS Private Wealth Management. Ali, good to see you. We've seen this give and take of momentum over pretty much the entire summer. What do you make of today's bounce?
Look, there's been a A lot of noise out there. I think some of today's bounce probably has to do with just excitement and expectation about NVIDIA. But we're in a market where we are, I think we talk about earnings a lot and what a tailwind that is, but I don't think we really have understood that the earnings picture is extremely severe and sophisticated, because what it's doing is it's taking a market where we used to focus and reward companies that were capital light with companies that are now increasing margin and increasing CapEx and really fundamentally shifting growth. And so for me, it's August, volume is light. You know, a lot of institutional players are sort of well positioned in the momentum space. So even though the traditional September is a little bit negative, I think there's a significant possibility that that is not the case this year.
How are you thinking about all the macro factors? Obviously, we've got Jackson Hole later this week. We've got some economic data we're expecting tomorrow. How do you see the setup heading into this week's events?
So there are three main events, and you've talked about, you know, PCE coming out, Jackson Hole, and NVIDIA earnings. I think that all of them will be more benign than we're used to, and I say that for the following reasons. NVIDIA is pricing in, from a volatility perspective, the smallest move in the options market that it's seen in 8 quarters. And that's not surprising. If you look at most analysts' expectations, and certainly ours, we think this is going to be a less severe both numbers and growth and changes to the forward estimates. So that makes sense in terms of sort of what you're seeing in the market. Jackson Hole, I think, will also be disappointing to a lot of individuals. People are really hoping and expecting that Warsh will change his tune, especially given what we've seen out of Bessent and conversations around manipulation of the curve. But I think that's a little bit naive to expect that he will deviate from any of the communication or lack of communication and forecasting strategies. And then in PCE, I think you'll see a little bit more of the same, which is I think you will see that, inflation is decreasing. And so that these overall, these three things that we have, as tailwinds of the market that continue to have us being bullish, very robust earnings picture, AI and secular tailwinds, and moderating inflation will continue over time and through the noise, especially the interest rate curve noise, to keep markets coming up.
So, Ali, if you're right that the catalysts are going to be friendly, positioning is light, September maybe treats us better than we're used to, does that tactical strength carry us through the historic sort of midterm weakness?
That's interesting. So, as we've seen, we're talking today about Canada and India. We obviously are months and months into the situation in Iran, and the market is reacting less and less to geopolitics and politics in general. I do think that for a number of reasons, social, political, and likely economic, this is a meaningful midterm election, so there will be some volatility. But at the end of the day, I have to point back to earnings, right? If we are right and we see a 2025 earnings picture that has 25% earnings increases and above, and 2026 at high teens, then we're talking about a market that could be at 8,100 and still at today's multiples, which seem quite fair given the structural changes in earnings momentum we have. So will there be volatility? Most definitely. Can we get through that up and to the right besides that volatility and into year end and through 2027? I absolutely think so. And so what does that mean? It means we continue to buy short and medium term duration. It means that we continue to buy developed market equities. A lot of the things I mentioned and I'm highlighting about the US and S&P 500 also translate to Europe and Asia ex-Japan. We continue to buy gold because of decreases in inflation, real interest rates moving lower, and de-dollarization. And we continue to buy fixed income and equities for those. So I think that, yes, we should expect that we continue to have volatility as we see CapEx and some sort of things and phenomenons that markets are not used to. But I think that ultimately you are going to be rewarded for taking risk on in many, many forms right now.
Yeah, gold and crypto back in focus with, a lot of discussion about the debasement trade and so forth. Ali, thank you so much.
Wonderful. Have a great rest of the summer. See you in the market. See you in the NYSE soon.
Looking forward to it.
As we're talking, we are getting some further details on Canada's response to the U.S. Let's get back to Megan Casella. Megan.
Carl, officials laying out, as promised, some of those products that are now going to see tariffs. These are all set to take effect the day after Labor Day. That's September 8th. It's going to be tariffs of 15%, 20%, and all the way up to 50% on about 700 different U.S. goods, about $20 billion worth of U.S. exports to Canada. That's about $27.6 billion Canadian. Now, some of the products that are going to see these tariffs: seafood, dairy, farm equipment, household appliances, lumber and paper, steel, clothing, textiles, and beauty products. On steel, those tariffs are going to double from the 25% rate where they currently are up to 50%. That will match exactly where the U.S. already has tariffs on steel. We're still getting more details on all of this, Carl. The press conference is still ongoing, but clearly holding true to their word here, not hitting the most sensitive of industries, which would be energy, at least in my view, but holding true that it's going to be dollar for dollar, and they've been clear that they're willing to do more of this if they need to. Guys, back over to you.
And also not matching the president's January timeline for autos and auto parts, right? They're going to do this pre-midterm.
Yes, so this is interesting to take a look at the timeline. The president did have some 50% tariffs that just took effect on Saturday, this past Saturday. That's what this is in response to. That's the $20 billion, and now we're seeing the $20 billion in response. But you're right that President Trump has already said he's going to escalate further on Jan 1, doubling the tariffs on cars and car parts. That will really have an impact in Canada. The fact that the timeline is so far down the road suggests there is still time to negotiate, but you're right about the midterms. That's smack dab in the middle of this, and Bloomberg was already reporting over the weekend that Canada isn't even expecting to have more negotiations with the U.S. until after the midterms. So it also suggests that we're in here for a long timeline.
Megan, thank you. As we continue to watch the pictures out of Canada this morning, that's our Megan Casella. We will talk to the Premier of Nova Scotia on this escalating trade war later on this hour. We'll talk about the impact of the new tariffs on the province.
And up next, BMO's Chief AI and Quantum Officer will join us. We'll discuss the key themes she's watching and where she sees opportunity right now. We're back in a moment. Welcome back. NVIDIA and Perplexity out with a new partnership this morning as more companies are trying to bring AI away from the cloud. Kate Rooney joins us with more. Kate.
Hey, Leslie. So as you mentioned, NVIDIA and then you've got AI startup Perplexity are making this push to bring AI directly to your desktop versus running it through all the major cloud providers. So Perplexity this morning out with that announcement saying it's the first what they call full stack AI platform that can run entirely on local hardware, so local computers. It is going to run on NVIDIA's AI computer that's designed to really run some of these large AI models locally. It's called DGX Spark. Perplexity said during a demo that the more hardware partners, I should say, are going to be coming. And the pitch here that they're making is about lower costs. So instead of sending every prompt, every piece of data out to a data center, to a cloud provider, the AI can just run directly on this machine. So potentially lowers compute and then token costs, which is a big topic for a lot of CFOs we talk to, but also potentially help keep some sensitive data private so you're not sending it out there to the cloud in this example. So Perplexity, though, still does say if a task is going to require more powerful frontier level reasoning, the system is still going to be asking a user for permission, and then it still needs to send a portion of that out to the cloud. So interesting note as well, it is going to launch on Alibaba's open source Qwen model. That will happen locally, and then it does say NVIDIA's open source model is going to be coming soon. Perplexity not alone here. We've seen Apple do this with the Mac Mini. It's been betting big on local hardware and AI, and then has this partnership with OpenClaw, if you remember the buzzy AI agent. And Microsoft is also pushing into some of these AI devices as well. The big question is going to be performance. So some of the most powerful AI models still do need to run in the cloud. Perplexity's system itself will still need to send those harder tasks out to the cloud with user permission, as I mentioned. So not entirely going to be able to run locally. And then for NVIDIA, it is another signal. This company is positioning itself in every angle of AI, including some of these smaller local hardware plays. It does also come, guys, amid some M&A reports between these two companies. NVIDIA reportedly looking to buy Perplexity for about $30 billion. No comment from either company on that, but clearly getting closer on the partnership side. Back over to you.
Yeah, build it and maybe potentially down the road buy it. Kate, I wanted to get your thoughts on the news out from OpenAI, which released some new benchmarks related to its Jalapeno chip, arguing it has better performance and energy efficiency than NVIDIA's counterpart. What do you make of that as we think about just this complicated web of the full stack of AI?
NVIDIA is everywhere, Leslie, every headline. Well, it's OpenAI in particular has been trying to diversify away from NVIDIA. I mean, we've seen this with Amazon. We've seen a lot more competitors. We've seen other companies try to basically do what NVIDIA is doing. And again, it gets back to the cost discussion. So for OpenAI, when they announced this, they said, in part, it's a way to lower their own costs as this company looks to go public. It's very important for margins that they're able to control the cost a bit more. But interesting on performance, I think a lot of the up-and-coming semiconductor makers are seen as sort of a cheaper option, maybe less competitive. If OpenAI is saying here that it is more cost-efficient and better than NVIDIA, that's something to pay attention to, and also potentially a line of business for them. If it's not only for them internally, if they start to go out and sell custom semiconductors, that potentially bullish for OpenAI in an IPO if it's another revenue stream. And so clearly signaling that they're seeing momentum here. It's not just, for their own purposes. Could also be seen similar to what we've seen with Amazon as Andy Jassy's call it, sort of a new pillar of that business. And so a lot of people have been paying attention to that. Interesting, though, if they're giving updates on it, and clearly they are seeing some momentum based on what they're saying today.
Yeah, that would be an incremental tailwind, that's for sure. Pretty interesting, Kate. Thank you, Kate Rooney, this morning. For more on the health of the AI trade as we get ready for NVIDIA tomorrow, let's bring in BMO Financial Group Chief AI and Quantum Officer Kristen Milchanowski. Kristen, welcome. Good to have you.
Nice to be here. Thanks, Carl.
It sounds like you're kind of locked in on real-world deployment, and like the horse race can exist, and clearly it does. But you think 27 will be the year of use cases and metrics and how corporates are putting this to work?
Well, what I hope for 27 is that we move away from use cases and we're really focused on scalability across the industry. I think that shift is time. We've been dealing with tons of pilots and different use cases for about 3 years now, and I think most of us have the rhythm and the beat to knowing how to scale and really get this embedded in everyone's infrastructure. I think that's what we can look forward to in 27.
Do you think companies When does that start getting reflected in not just the guidance and sort of qualitative commentary, but giving us fresh metrics that the street can use to judge how this is getting used at scale?
Carly, you're right. I think we've talked a lot, especially in the last 12 months, about expenditure and CapEx. And I think what we should see, what I would hope to see, is a shift towards business value. So really, where's that return coming from? And having some of those market, talking about the improvements from efficiency, productivity, and then even on the revenue side, I think we can start measuring those things as this scales in 27. So I'd like to see a shift in the conversation from just the expenditure and how much people are investing in this towards what the value is coming out of it.
How does that conversation actually shift? What do you need to see happen to be able to focus more on ROI? We've been talking about this for some time. I'm just curious, what changes?
What changes is really the deliberate decision by your business leadership teams to focus on what is the business value outcome that you're trying to achieve. And when you're that focused on the big rocks, moving the big revenue blocks, that conversation then turns inward to your CFO, and you have all the parties at the table, and you can really commit to that deployment activity yielding that result, and then eventually you would see it on the financial statement at the end of the day. So that's the progression that I think many of us in the industry are working towards.
You have quantum in your title as well. Is quantum, how do you think of it as powerful as this initial AI wave, but is the delivery just going to come later, like a second wave of productivity?
Quantum is going to solve entirely different problems, so it's something that's going to be complementary to the AI agenda. And the way that it's going to come, I don't think it's going to be this massive burst onto the market as AI was for all of us a few years ago. Quantum's going to come a little bit more silently, but it's something that I hope people are preparing for now, because we are going to see quantum advantage in the next year, if not within a year, is my prediction. And so preparing for the security side, preparing your business cases for quantum is something that you really need to start now, because when that advantage is unleashed, it's going to be really hard to catch up to that advantage.
That might explain why so many companies are putting a lot of effort into it even now, Kristen.
It really does.
Yeah. Appreciate it very much. Good to have you. Kristen Milchanowski
Thanks for
over
having
at BMO.
me on. Thank you.
Still ahead, United announcing its largest international expansion ever. Move as part of the broader growth strategy, with highlights from the CEO.
CEO of Tanger is with us. We'll talk about back to school, what's happening in some of these categories. Dick's is obviously a story today. We're back in just a minute. Welcome back. United unveiling some new planes and some new destinations this morning. Phil LeBeau joins us after speaking to the CEO. Nice to see some capacity finally get added, Phil.
And quite the capacity we're going to show you, Carl. It's show and tell time. This is the new United Airbus A321 XLR. Single aisle aircraft. Usually don't see business class seats like this. This is their new Polaris Privacy Suites. Check this out. TV comes out like this. You can lay back if you want to, take a nap on a long flight to Europe. And check this out. The door. It's a privacy door. There are 20 seats like this here in the Polaris section of the new A321 XLR. This is the expansion that United announced this morning. 10 all-new destinations. Most of these are transatlantic, but to smaller cities. Think Valencia, Spain, Catania, Italy. We're not talking about Rome and London adding flights there. We're talking about adding new destinations here. They are going to be starting these flights in the summer of next year, and again on the A321 XLR. This plane has the capacity for 150 seats. 32 of those will be either Polaris business class or premium seats, one section back. But even in the economy section, there's going to be a snack tray in the very back, a cart where you can get up in the middle of the flight. You don't have to wait for somebody to come to you if you want to get a snack. We talked with Scott Kirby, the CEO of United, earlier this morning about whether or not he is seeing any slowdown in people booking for premium class or really bookings in general. And he says, nope, not yet.
We are not seeing a slowdown at all. I looked at the bookings this morning from yesterday. Really not even a blip in demand so far. And it's true, it's across the board. Business demand is strong, but leisure demand is strong.
Take a look at shares of United. The other piece of news that Scott Kirby made when talking with us this morning on Squawk Box, he does not expect to see a dramatic drop-off in jet fuel prices. He sees it easing gradually as you go into early next year, but it's going to be remaining elevated as I go back inside one of the Polaris Privacy Suites here. And when I asked him about what's going to happen with the airfares, guys, he was honest. He said, look, they're going to stay where they are, if not increase a little bit. That's simply a reflection of the market right now and how much demand is out there.
It seems, Phil, you look very comfortable, by the way. It seems like this new strategy.
I'm not even laying down here.
I know, you got to just turn on CNBC, maybe take a little nap. It's a tough assignment. But before we let you go, it seems like this new strategy to smaller cities would be more to appease or appeal to the luxury travel, the consumer travel, not so much business travel, right?
Yes, primarily. That's the case. And look, there is no slowdown in demand for any airline when it comes to adding flights on the transatlantic routes. And that's why United, when you look at their expansion, yes, they've added more international flights than any other airline, a U.S. airline, over the last several years. Why have they done that? And they've done some in Latin America as well as Asia, but a lot in Europe, especially the southern part of Europe. There's so much demand. When you talk about people who want to go to Valencia, Spain, that's why they're going to be flying there. They're adding 2 new destinations to the island of Sardinia. Think about that. If you would have mentioned that 5 years ago, people would have said, well, who's going to fly directly to Sardinia? United's going to start doing that next summer. That's because the demand is there.
Yeah, I flew last summer direct to Catania, Italy. It was great. Super easy.
There you go.
And it was probably a full plane. Phil, thank you. Time now for a CNBC News update. Frank Holland has that for us. Hey, Frank.
Hey, good morning, Leslie. The Supreme Court is allowing President Trump's restrictions on who can receive mail-in ballots to continue for now. But in the 6-3 ruling, the High Court left uncertain whether those restrictions were legal and could be used in the midterms this year. A lower court is still weighing the legality of Trump's executive order that would create a federal list of eligible voters to receive mail-in ballots. 2 people have died of the measles in Pennsylvania, according to the state health department. Both were unvaccinated against the disease. It's the first measles-related death reported in the state in 35 years. According to the CDC, it is the worst year for measles in the U.S. since 1991. And Target is pulling a children's Halloween costume from its shelves after facing criticism the design evoked racist stereotypes of black people. Critics were quick to point out that the circus clown costume and promotional imagery mirrored caricatures from Jim Crow-era minstrel shows. The retailer apologized in a statement saying that the costume is offensive and should never have been part of our assortment. Carl, back over to you.
All right, Frank, thank you very much. Still ahead, CEO Tanger is with us. Speaking of retail, we'll get his outlook for the consumer. We'll talk some back to school and why he's closely watching this comeback for the movie theaters.
And later, has oil demand in China peaked? We'll discuss the factors at play with oil hitting a one-week low today. We're back in a moment. Welcome back to Squawk on the Street. Consumer confidence edging lower again in August to its lowest level in 7 months as Americans become increasingly pessimistic about the future of the U.S. economy. And Dick's Sporting Goods under a lot of pressure this morning, seeing the worst day on record. Its CEO on the call saying consumers remain more cautious than expected. Here to discuss his own outlook for the retail sector, Tanger CEO Stephen Yalof. Good to see you, Stephen. I want to start with Dick's because it's such a dramatic move today, and I'm curious if you think that this is an idiosyncratic situation or if there's a broader tell for the rest of retail.
Well, first of all, thank you for having me on. Our take on the Dick's situation is it's really more of a Foot Locker problem than a Dick's problem. I think Dick's has posted great comps and has good outlook going into holiday. I think Foot Locker got caught in a little bit of an inventory crunch, a lot of legacy product.
So you think it's temporary and they can work through it and...
I think so. I think, it's up to the brands, especially that they're selling, to bring more innovation and more newness into their product mix, that's what the customer is responding to right now.
But it is hitting, it's having somewhat of a ripple effect onto other retailers today, Nike, Lululemon, just to name a few. Do you think that's a signal to the market that there may be some just broader consumer consternation out there?
Well, let's say the consumer's still spending, and at least that's what we're seeing across our portfolio, but they are a lot more intentional. And I guess that intention is what we're seeing in the numbers today.
Talk about the business as we go into the season. What's been the cadence? How's it feel? Is there a lot of geographic disparity, for example?
Well, for the summer, has been driven by two key events. First of all, World Cup. World Cup's brought a lot of international customers in, and they brought them to markets that they don't typically visit. Kansas City is one. We have a great shopping center in Kansas City. Okay, your hometown. And we saw a lot of customers come through that center. And not only are they shopping for American products, which they love and they want to bring home, but they're going to all of the great American hotspots. We talk about Buc-ee's all the time, and I'm sure you all visited Buc-ee's, but that seems to be on the, sort of the itinerary for a lot of these folks that are coming. The other major event that's happening during the holiday, during summer, is back-to-school shopping, which is the second biggest shopping holiday of the calendar. And it starts as early in June. You asked geographic. In the South, when schools ended a little bit early, we start that back-to-school selling cadence as early as the middle of June, and it takes us through the rest of the summer.
We teased you watching movie theaters, but it has been the best box office year since 19, I think. Are people shopping around it?
Yeah, well, it is. I mean, a number of things are happening in the movie theaters too. I mean, first of all, now movies are just in theater, which is a new thing that we're seeing in the last couple of years, when streaming and theaters were open, movies were opening at the same time. But more importantly, when Odyssey, as an example, shot on 70 millimeter IMAX, hard to find tickets. Tickets are so rare, and we have a few IMAX theaters in our portfolio. It's rare enough that folks are booking tickets ahead of time. They're making purposeful trips. They're coming to the center. They're using the restaurants. They're staying later. And when they're showing the movie 24/7, we're seeing customers on center at times we've never seen them there before.
Got to open up those stores, keep them open until 3 in the morning for that. How are you thinking about the deluge of macro factors out there? What a higher yield means for credit card spending, for example, what the tariff, the renewed trade war could mean for just the pricing and margins?
I mean, these are things that we think about every day as a company, and we're grateful for the value channel, because the value channel really seems to be sort of the anecdote for a lot of those issues. I said earlier that the consumer's spending, but they're a lot more intentional. That intention is showing itself in the value that they're choosing. So if you look at across our portfolio, particularly the outlet portion of our portfolio, that customer wants the products that they want, the brands that they want, but they want them at the best possible price. And when you can get that every single day in an outlet environment, we see a lot more cars in our parking lot. We're also adding things like movie theaters, restaurants, other amenities, services, group fitness, things of that nature, which we want to get the car in the parking lot for that trip and then keep them for the shopping too. So those two things seem to be working really well against one another.
Can we make some assumptions about holiday for now? I mean, or at least in inventory levels, anything else?
Yeah, I personally, we're really optimistic about holiday. We're planned, we're going, as we go into budgets, which is something that we do, one of the first things we look at is how are the retailers, how are they forecasting holiday season? Because are we consistent? Are we thinking about this the right way? And there's very few retailers that have pulled back their holiday guidance. A lot of the major retailers are looking to grow their business, maybe 3 to 5% going into the holiday selling season.
Wow. Full speed ahead. All right. We'll let that countdown begin to the holiday season, Stephen. Thank you.
Thank you.
Good to see you.
Thanks for having me.
When we come back, Nova Scotia's premier will join us on this escalating trade war between the U.S. and Canada. We'll get his reaction to the latest tariffs coming off of that news conference at the top of the hour. Stay with us.
Canada must respond, and today we are, in a proportionate, targeted, and strategic way. Today I'm announcing that Canada will match the United States tariffs dollar for dollar, rate for rate. Effective September 8, Canada will impose counter tariffs of up to 15, 25, or 50% on $27.6 billion in imports from the United States of America. For each product, our tariff would match the American tariff on the same type of Canadian good.
That was Canada's finance minister earlier this hour, unveiling retaliatory trade measures on the U.S. in response to the president's plan to impose additional 50% tariffs on a range of Canadian goods. Joining us this morning is Tim Houston, the Premier of Nova Scotia. Premier Houston, thank you for the time. It's good to have you.
Bill, thanks for having me. I appreciate it.
So what do you think an American audience should take away from this announcement today?
Look, we're making a response from Canada that's, I would say, is necessary and appropriate. But the reality is that this is not good for Americans, not good for Canadians. We have a long-standing relationship, family ties, business ties, trading routes. We're military partners. There's a long-standing relationship here, and we're not on a good path right now. So I think from the Canadian side, we want to get back to a place where we can trade more freely with each other, and we can just enjoy the benefits of being friends and neighbors and supporting each other as we grow our economy. So we need to get to a point where we can take. There's a lot of emotion in the air right now. We need to take a little bit of air out of that bubble and hopefully get to a place where we can negotiate a fair deal for everyone.
Right. What do you think? What will it take to get the air out of that bubble and at least get back to some discussions?
Yeah, I'm not too sure because it's a really difficult time right now. So, but look, the history is on our side. I mean, the relationship between Canada and the United States, it's more than transactions. I mean, we talk about tariffs and exports and imports. Those are all economic transactions, and they're really important for both countries. But what we have is more than economic transactions. We have a full relationship. And I think that relationship, which, there's a lot of emotion involved because emotion comes into play in relationships. But this is not good for Americans. It's not good for Canadians. And if we can just get past this, then we can work together to strengthen both economies and really, take on what's really possible for both of us. So hopefully we can get back to the table. We can get through this and get back to the table and get back to a more normal relationship.
Are there measures that Nova Scotia and elsewhere in Canada are taking to protect themselves in light of the uncertainty, doing more deglobalization, cozying up with other countries while the uncertainty exists with the United States?
Yeah, absolutely. I mean, what I say to Nova Scotians and to Canadians as well is we can't control what happens in Washington. We can't control the policies of this administration, but we can control what happens in Nova Scotia. We can control what happens in Canada. So we've been very focused on the energy opportunities we have. Nova Scotia has lots of natural gas onshore and offshore. We haven't been really focused on developing that. We import a lot of natural gas right now. That's ridiculous in this environment. We should be developing our own. So natural gas, we'll push on that. We have oil, we'll push on that. We have incredible wind resources. We'll develop our wind resources. So in the energy space, we know we need to be more self-sufficient because we can't, there's certain partners we just can't depend on anymore. So we're doing that. But we're also, as you say, looking to diversify our markets. So all the exports that go to the United States, we're looking for other trading partners who are looking for reliable partners. We're looking for good products that we can offer. We can offer them across the spectrum: seafood, forestry, all kinds of products we have that the world is looking for, critical minerals. The world's looking for them. We have them. So we've, lesson learned here. The United States will always be a significant trading partner of Canada and for Nova Scotia, but we also know we can't put all the eggs in one basket. We need to find other trading partners. We're working to do that, and it is being successful. So the relationship is altered for the long term, but I think we can get back to a more normal, more respectful, fair relationship. And I think that's what Canadians want. But right now, as I say, the emotions are really high right now.
Well, over the weekend, a lot of people were recalling the Prime Minister's Middle Powers speech at Davos and thinking about what options Canada might have. Have you heard from any leaders in, say, the EU about the stance currently vis-a-vis the U.S.?
Yeah, I think there's a feeling in the world that the United States is alienating itself, and there's a lot of Canada, the long-standing relationship we have with Canada, that's been turned upside down. It's in chaos right now. But Canada's not alone. If you look around the world, there's lots of people that are feeling, uncertainty as to the American positions on lots of fronts. So definitely this is a time of great uncertainty, and we're, in Nova Scotia trying to use this moment to make sure that we are better prepared for the future, and we'll dig in on that. Canadians are digging in, and as I say, the emotional part of the relationship, the economic transaction, we can, at some point a deal will arrive, and that will deal with kind of the economics, but the emotional part is longstanding. So if I look at the alcohol situation, we've taken the, U.S. alcohol off of our shelves. There will probably be a time when that is returned, but I don't know that people will rush to buy it because of, these are the types of long-standing, long-term implications that they're happening right now, and there'll be a long time to unwind. So we'll dig in on what we can do and focus on that, and then we'll hope for and work towards a day where we can have a more normal relationship with the United States, significant trading partner, neighbor, and friend.
You mentioned that there would be an economic impact on both sides of the border. What's the popularity of these measures within Canada? It sounds like emotions are high. Do you expect that to continue if there is more of a significant economic impact?
Well, I think the Canadians are very united right now. Like the national pride, the loyalty to Canada is very, very high. And that's one thing that it has, the Trump administration policy maneuvers have solidified Canadian unity for sure. I mean, so right now there's very much, we got to fight. That's definitely the feeling of Canadians. We do feel like, this has been something pushed on us. We have been attacked in a certain sense for sure with these tariffs. We feel that as Canadians. I feel it. So now we're responding to that. But we also know that, for the long term, for the benefit of both sides, we need to get to a place where we have a more normal, respectful, fair relationship. I certainly want that, and I think Canadians want that. But in this moment right now, we're responding to something that has been done to us. And we are responding very forcefully, for sure.
And does the suggestion of changing Lake Ontario to Lake America, does that move you incrementally back to the table?
It's just one more thing, in a world where Canadians have been called nasty. We're not nasty. The rhetoric about, the 51st state, all of that stuff. It's just one more thing. It's just one more thing that pushes Canadians more solidly together, more unifies us more. So, but again, that's I would call that rhetoric of the moment. We need to get past that. This is too important for both of our economies. We do a lot together. Right now we're cooperating on military operations. Somewhere in the world for sure. We trade significantly back and forth. So if we can find a way to rise above the rhetoric, then we can get to that economic transaction. And once we get to that economic transaction, then we can ultimately start to stabilize and normalize the emotional component of all this, which is very high right now. But we're responding in a way that's necessary. It's forcing us as a country, and certainly here in Nova Scotia, as Premier of Nova Scotia, very focused to look at the opportunities that are before us so we can be more self-sufficient and have more reliable trading partners that we can depend on for our products. So that's happening. That changes the relationship forever, but there will be a normal where we can rebalance it at some point, and we just have to work towards that day.
Tim Houston, Premier of Nova Scotia. Premier, thank you so much for your time. Busy one for you. Appreciate it.
Appreciate it. Thanks for having me.
Still ahead, has oil demand in China peaked? We'll discuss with oil prices hitting a one-week low today. We're back in a moment. Welcome back. Is China's peak oil demand in the rearview mirror? Pippa Stevens joins us with more. Hey, Pippa.
Hey, Leslie. So new comments from Chinese refiner Sinopec, the largest in the world, suggesting some of the shifts in Chinese consumer behavior following higher energy prices after the start of the war with Iran could be stickier than initially thought. During an earnings briefing, the company's chairman reportedly saying the country's oil demand very likely peaked last year, with first half results showing domestic refined oil product consumption falling 8.6% year over year. China has effectively become the global oil market's balancer, with imports dropping more than 40% since the start of the war, freeing up oil for other nations and curbing what some analysts have said would have otherwise been a move deep into triple-digit territory for crude. The country has been able to maintain those lower imports because of its 1.2 billion barrel reserve that it built up prior to the war. We don't know how much of that has been drawn down, and depressed prices for Gulf oil has brought China back to the market. But China is the world's second largest oil consumer behind the U.S., so demand potentially peaking earlier than expected adds to the bearish narrative of an oversupplied market into 2027. But guys, what's so interesting here is that prior to the war, we always talked about the swing supplier. Now we very much have a swing consumer.
Yeah, it would be interesting. Some have suggested, Pippa, that if China were somehow boxed in on sanctions or wanted to retaliate a little bit, it wouldn't take much to at least rhetorically turn on the buy signal and, as you say, elevate some crude prices for Americans.
That's right, and particularly with the midterms coming up and Americans very much focused on the prices at the pump. Today, diesel is just 20 cents below June's record price, and that is definitely eating into consumers. And so if China were to say, okay, we're going to run full steam and import a lot more, that would certainly have global economic repercussions.
Yeah, not today, though, with Brent below 89, a little bit of relief, along with some of the fertilizer companies, Dow and Lyondell, lower today. Hopes for some progress in the Middle East. And yields, too, with some relief for equities.
Absolutely. Energy also lower today, just as a sector, in light of all of this, lagged only by consumer staples.
Let's get to the judge back at Post 9.
Thank you very much, guys. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of the AI trade is the biggest earnings report in weeks. Looms large. The committee setting the stage for NVIDIA and what it means for the broader market. Joining me for the hour, Joe Terranova, Stephanie Link, Carrie Firestone, Josh Brown. Let's check the markets. We are green across the board. Dow's trying for 3 up days in a row. Tech is leading. And on that note, we set the stage. NVIDIA tomorrow. Stock's been down for 7 straight days coming into today. It's the longest losing streak since September of 22, and it comes right on the back of one of the longest winning streaks that it had in some time. So what's riding on this? What do we think? Well, NVIDIA's next leg, obviously riding on it. What about the semi-trade itself? That's probably riding on it. The hyperscalers' near-term direction? Probably, right? So you got a lot at stake. There's no question about that. Josh Brown, you agree with our list, and do you have more things that you think are riding on this report tomorrow?
So Sean and I took a look at exactly what you're talking about, not just what the narrative is going into the report and what's riding on it, but the reaction. And this is not a great earnings stock. It really never has been. I don't mean to say the earnings aren't great. What I mean is there's always a lot of buildup, a lot of anticipation, but most of what the stock is going to do typically in a given quarter is dictated by what their top 5 customers say. And we got those reports 2 to 3 weeks ago. So if you go back to Q1 of 2020, I think that's a lot of time that we can judge. The average return for NVIDIA at the close of the next trading day after reporting is plus 2%. That's not much. There are 2 massive reactions that are skewing that average up. One of them was a 24% move in May of 2023. I think we can all agree those days are over. The next biggest one was plus 16% in February of 2024. If you strip those 2 out, the average return for NVIDIA the day after earnings is literally flat. Of the 26 reported quarters in that time frame, only on 12 occasions has the stock gone up or down by 5%. So it's really not, I think, about what the stock itself is going to do, although I would love a post-earnings rally as a long. Again, and we talked about this last week, and it was very important, NVIDIA, Jensen Huang in particular, is the AI Fed. And we absolutely need to hear confirmation of all of the things that we think are going to go on in the next 5 months into the end of the year and in 27. The guidance matters to hundreds, maybe 1,000 stocks more than it probably matters to the NVIDIA share price itself. And I think for that reason, this will be the most watched earnings report of the entire season.
Yeah, I just don't see how anybody is really going to disagree with that. Joe, I thought there was an interesting story today on NVIDIA's dependence on the hyperscalers faces a big test in this earnings report. That's the headline. The company's hypergrowth has been driven largely by tech's hyperscalers, which have purchased GPUs in bulk. But those companies are seeing their free cash flow erased as they pour money into CapEx. Right? Everybody knows that. Here's the question. Can NVIDIA rapidly diversify its business by providing financing options to a wider swath of customers? You can't have this dependence on the hyperscalers be your only game forever. Do they need to do that? They become the banker to the AI boom, says the Wall Street Journal today, putting it on dangerous ground. That's sort of the similar thing. What does that mean?
I think it's dangerous ground. I also think that you have to acknowledge that prices are going to continue to rise, and what NVIDIA is charging is only going to move incrementally higher. So at what point do you hit the ceiling where you see the elasticity as it relates to what demand ultimately looks like? So I think that's one of the reasons why the valuation has cheapened so significantly, because I really think that this earnings call on Wednesday is going to be critical for Jensen Huang to be the voice that pushes against the data center pushback that we are seeing around the country. I think it is going to intensify as you move into the fall. It's an interesting statistic that was brought to my desk this morning. Data center construction is now 2.5%. That is bigger than infrastructure construction in the entire country. Think about that. We are now building out data centers more than we're building out infrastructure. So I think this has to be the beginning of that conversation where he engages, because to Josh's point, if he's the central figure in the AI construction, he needs to address that. He needs to address that element. Also, one other point, and we'll get into this later in the show. Let's not forget, we have two really important earnings reports this week. Marvell follows on Thursday. We'll talk about that more in a little bit.
Oh, I thought you were going to finish the thought.
No, so we'll talk about that more in a little bit. We're staying on NVIDIA.
All right, thank you. Thanks for the tease. Yes, we're going to talk about Marvell. I thought there were more words coming. At any rate, Steph, so B of A talks about this coming report. Beat and raise expected, right? Check, check, we agree. They talk about a buyback. A bigger buyback could defend EPS quality, similar to what Apple did post-2012 with its own playbook, right? That, I think many people view the massive buyback that Apple initiated as somewhat of a floor. How you can't get too negative on Apple because of the massive buyback. They're always buying back their stock. You made the case yesterday with me on Closing Bell. I don't want to buy back, you said. And you were pretty, demonstrative about it. I do not want a bigger buyback.
Well, I don't mind a buyback.
Well, you said it.
I don't mind a dividend. I don't mind a dividend increase bigger than what they did when they initiated. I don't mind that at all. What I mind is if their growth is slowing, and it's not slowing. But if the growth is slowing and then they do a buyback, that's what Apple did. Their growth went from 20, 30, 40% growth down to low teens, and that's when they started initiating a buyback. So if the growth is slowing at NVIDIA, if that's the indication that we get from the company, that's the reason why that they're doing more in terms of shareholder returns.
Your case yesterday was you want them to spend.
I think they will continue to spend, number one. I think the fundamentals are going to be great. I think they're going to see more compute backlog higher because we're short compute, we're short memory, and hyperscalers are spending all their money, CapEx right now, on memory. So I think you're going to see good backlogs, free cash flow, getting back to your point, $200 billion this year, $300 billion next year. They already committed to returning 50% of their free cash flow to shareholders. So if they make an announcement today, okay, they make an announcement. I don't think They will, because they've already committed to, they are going to over time. My biggest question is, if they do it, is it because the growth is slowing? And I don't think that is the case.
Wasn't Apple's growth wasn't really slowing when they did buyback, didn't they?
Yes, it
I mean,
was slowing.
their services.
It was decelerating.
Their services business was almost in the still nascent stages, growing into this behemoth that it.
We do not want
is.
dividends.
But it's only 20% of their revenues right now in terms of services to Apple. So, I mean, it's been growing, sure. But the overall growth rate has been slowing at the company for years.
Josh said, what did you just say? You don't want a dividend?
We do not. No. Speaking on behalf of long-term NVIDIA shareholders, we do not want increased dividends. The tax treatment of dividends is absurd relative to the tax treatment on buybacks. The tax treatment on buybacks is 1% the company pays. Dividends are double taxation, meaning NVIDIA is paying the tax on earning the profit and then distributing it to us, and we pay another tax. Nobody wants that. NVIDIA is not going to yield 4% to the point where the dividend is going to attract a new shareholder base. So of all of the things that they can do, for me, and I think I'm speaking on behalf of many NVIDIA shareholders, institutions, and individuals, please reinvest into robots, automation, get involved in space, anything but paying me a 0.5% dividend. What am I supposed to do with that? What are we collectively going to do with that?
I think the most important thing on the conference call is the earnings path to $15 a share by 2027 and eventually getting to $20 by 2028. And what happens to gross margins in that scenario? Do they stay in the mid-70s, or if they decline? If they decline, the market is not going to like that.
They talked about raising price, right? Wasn't that story yesterday?
Right. That's why I don't think that that's the case, Scott. The reason I bought this thing is because it's 18 times earnings, growing 85% with gross margins in the mid-70s, period.
Raise prices, defend margins.
So I think so, and they can raise price. That's really, but I want to get a little more detail on the earnings power, because my goodness, $20 in earnings power by 2028 makes this even cheaper than 18 times.
Care?
Well, I was just going to say that everybody knows this is going to be a great quarter. What we really need to hear is what he's thinking about the third quarter and what he's thinking about next year. And if we can do a guide that's 110 billion revenue plus for Q3, that possibly could move the stock. If there is something that really excites the market, which has not generally been the case, as Josh pointed out, there are many people who don't own NVIDIA even close to the market weight. They might not own it. They owned it. They sold it when the stock was down. There were a lot of sellers during that period when everybody was saying, oh, kind of it's washed up. And you've got all of these low-cost suppliers and competitors. So competition is going to be a question people want to hear him discuss. And what's happening? Can we get to 110 billion or higher in the third quarter? And will that maintain the gross margin because the customers are willing to pay the price?
Do you think that all of those things that we put on the list are genuinely what's riding on this report tomorrow evening? Obviously, for NVIDIA's next move, how could you say otherwise? But the semi trade itself hasn't been great.
Yeah, I think that the semis are a slightly different animal right here. Everybody knows that this is going to be a good report. Is it going to change what happens with other semiconductors, with Micron, or look at TSM? Think about AMAT, all of the whole universe of stocks that have been up anywhere from 50 to 500%. Is that going to change because of this NVIDIA report? I don't really think so. I think it just got overheated and tired. It's a little tired right now. It could ignite, but I wouldn't be betting on it.
All right, so let's then move to Marvell. What Steph says is the second most important report this week. I think that's fair. I do. That's Thursday. The target to 300 at Rosenblatt, the target to 265 at Susquehanna. The stock's up like 170% year to date. So there's a lot, Steph, riding on this. Then Joe after Steph.
Yeah, I mean, there is a lot riding on it, and that's actually one of the reasons why I sold a lot of it to begin with, because I made a lot of money in it, but I still like it very much because I think at the end of the day, this company has a chance to get to $10 in earnings power, not only from optical, but also the custom chips. There's two ways you can win with this company.
Hey, let's clarify something real quick, too. When you were on yesterday with me on Closing Bell, you said, when I asked you which would you rather own for the next year, Marvell or NVIDIA, you said, well, I own both. Our audience knows of you as having sold Marvell in your main
in the main fund,
but
I have
you
another
still
fund.
have it.
It's small though,
Okay.
but I still have it because I want to participate in.
I just want to make sure we're all on the same page here.
Oh, sure, absolutely.
So you still own it,
yes,
albeit in the smaller fund, a smaller size than what you originally did when you sold it either in June or July.
Yeah,
right?
and I wanted to hold on to a little bit because I do think that they have strong growth overall, and I do think they can again get to $10 in earnings power. That all being said, you asked me which I prefer. The reason I prefer NVIDIA is simply because of the valuation and the sentiment on NVIDIA versus Marvell. I mean, Marvell's had a heck of a year, rightfully
Gosh,
so.
look at that move today again.
Rightfully so. They are hitting it on all cylinders. But by the way, I also think Broadcom is a better buy here for the next year. Again, the same reasons for NVIDIA. Valuation, they participate in custom ASICs. Marvell and Broadcom have an 80 share in custom ASICs, and everyone thinks that Broadcom is losing market share to Marvell. They're not. They can coexist, and I think that's the disconnect. So I think the report is going to be great tomorrow. I think numbers are going to go higher. And again, I think that they have a chance of getting double digits in terms of earnings growth between now and the end of 2027. I just think a lot is priced in.
Do we need to have a bigger conversation, by the way, about Broadcom itself and the fact that if you look at CDS and their credit risk is way up, and that's getting a lot of talk today. And it probably will continue much in the same way that how many days in a row did we show you the Oracle CDS? It became a story in and of itself. Do we need to focus as a Broadcom holder on that?
I think we need to focus on what's going on in the Treasury market and the effect of rising yields on the ability for hyperscalers to continue to issue debt at levels that are favorable to them. And I think that's becoming more and more a real issue. I think that's why Marvell is critically important on Thursday. It is a high beta AI trade. I said yesterday that AI trade needs a shot of adrenaline. Marvell is clearly the company that can give it to them and also can really speak towards what the outlook ultimately is going to be. Is there going to be sensitivity at a certain point if yields continue to rise where the hyperscalers step back and say, okay, these are yields that are unfavorable for us. We're going to go out, we're going to sit back, we're not going to go out and issue the debt. And therefore, you begin to see that liquidity flow into building out the infrastructure slow.
Yeah, so on Broadcom, I think we should pull up a chart because we all know that the stock has been, I would say, drifting downward over the past few months recently. Yeah, there we go. What's going on fundamentally? The business is great. What's the issue that's weighing on it? It's about debt. And to Joe's point, we have this dynamic where the Fed seems to be unclear about raising or holding rates, but the debt market keeps pricing interest rates higher because there's so much demand for debt. The amount of debt that has been issued by the hyperscalers is 14% of the entire amount that the Treasury issues in a year. It would be a relief to Broadcom if the Fed actually raised rates, which seems likely because then they'll be addressing inflation. The market will ease back.
What do you mean? It seems likely the Fed's going to raise rates? Because it seems unlikely.
Not right now, but I think if you go out a few months, I think they will. Yes. I think that they will because there'll be more inflation than they would like.
What if they don't? Because it seems unlikely that's going to happen. I think that's well far out on the curve of what we think is legitimately going to happen here.
If they don't, then we've got a few more months where we're feeling this pressure in the market of high rates to borrow at very large scale.
In other words, I don't see a scenario in which Chair Warsh and company hike rates a month before the midterms or
Yeah,
days.
no, they're not going to do it.
Days.
I'm not talking about November. I'm talking about a meeting after that. There's a likelihood that we'll see a higher rate just because there's inflation. And it will be good. We believe it'll be a relief to the market if the Fed removes that obstacle and pressure. Right now, they have to go out and borrow, and there's pressure to raise rates in the private market, which is what's been going on, which is why you're seeing some of these stocks like Broadcom and Oracle.
All right, Broadcom's
feeling
up
that
4% year to date. Oracle's, decidedly negative, obviously.
Oracle also has negative free cash flow.
Yeah.
Broadcom has $40 billion
Hugely
in free
positive,
cash flow. That's growing, right? And they're going to do $56 billion in AI revenue, which is going to be up 180%.
Why is the stock
year.
then? Why is the stock done when it's done?
One of the reasons why Broadcom is under pressure is because of the relationship with Alphabet and TPUs.
100%.
And now
That's why I mentioned Marvell, but Marvell
has
is not taking market share, 100% market share from Broadcom.
Not directly now, but potentially in the future they could take market share. That possibility is there.
All right, but Broadcom has a
91 billion
five-year
in debt.
deal with Google. Broadcom has a 5-year deal with Google, with Alphabet, until 2031.
Yes.
So you're going to all of a sudden start selling the stock today because maybe the deal that doesn't get extended in 2031. I mean, I think that they have a lot going for them. Why has it lagged? It's like the same thing. Why has Nvidia lagged? I feel like they both got very overowned. They had phenomenal years last year, and I think there's other things to do in the semiconductor space,
The buyers
like
have bought.
Micron, like Applied Materials or Lam Research or Marvell, et cetera, et cetera.
You and I could disagree with the price reaction for sure, but there clearly is an obvious one to that relationship that was announced between Alphabet and Marvell.
Josh?
Guys, this is not complicated. Marvell is coming on. I know Stephanie knows that. I know she wouldn't argue. Marvell was not in this company's lane as recently as 3 years ago before the AI pivot. It's $91 billion in debt in an environment where the cost to continue that is going higher, probably not going lower, even if it just stays static. It's a decent sized debt load relative to how well this company's doing, and it's 30 times forward, and I can buy Nvidia for less. And I think that's why the stock is struggling. Those are not reasons to sell it, but if you're asking why is this company a laggard in the space, considering how great their business is, those are the three factors: more competition, very high debt load, and a challenging valuation for people to get bowled up on it at today's prices relative to other stocks they could buy.
Hold on. You guys worried about? I want to talk about data center related stocks like the power players now.
Yes.
Are you guys at all worried about the backlash on data centers and this existential
100%.
threat of some kind?
I think we're going to disagree today on a couple of things because I don't at all.
Listen.
Because by the way, let me just say, over the last week, Quanta's down 14, Vertiv's down 13, Vernova's down 12.5, Eaton 10, and CAT, if you want to place it as that, it's down 8.
So the market trades off perception. A lot of times it doesn't trade off reality. So you and I are going to agree on this. I think the reality of the conversation in the long term, I think we're going to land in the same place, that it's not an obstacle. I think over the next couple of months, it's going to intensify dramatically the conversation, and I think companies like NVIDIA are going to have to address it. In particular, how fast the growth has been for data center construction in this country. I'm not saying that that's a negative. I think it's actually economically a positive thing. But there is this element of not in my backyard.
It's going to get built elsewhere. 11 states have restrictions. 11 states.
Yeah, but it's
going to
growing.
get built elsewhere.
It is growing.
But where the states accept it, they'll continue to be building in those states.
I know, but there are states that are now opposing it that you at the beginning wouldn't have thought that they would be on the list.
So the companies are going to pivot. In fact, I think it's good news in a way because it extends the cycle. You're not going to overbuild. If you can't build in 11 states, maybe it goes to 20 states, maybe it goes to 30 states. I don't know. It's going to get built, though, and it takes 3 years to build one of these things, and $40 billion, by the way, to build these things. This is why the hyperscalers are spending crazy. But at the end of the day, Quanta Services is still up 45% year to date. Vertiv is up 60%. GE Vernova up 43%. The backlogs are enormous and growing. Margins are accelerating. Earnings are growing in areas and growth rates that I've never seen. Earnings growth And Quanta Services is at 70%. That's huge. That's huge. So my point is, the pullbacks are a buy, in my mind.
So I own all the names that
I know, we do.
we're on the same page. Yeah. But is there justification? Can I make the assumption that potentially a lot of the commitments that have been made to build out data centers, because of the regulatory backlash and the conversation that intensifies growing into Election Day, we get a pause on that?
We're getting a little bit of a pause right now from these companies. They are pulling back.
Right, but I think
pull back more?
Steph's point is like 2 or 3 months. It doesn't change the story. If it becomes
the perception.
a more durable thing.
I said that at the beginning of my remarks.
I mean, what is Jensen Huang going to say on the call to a bunch of analysts that it's going to be? What is he going to have to go out and do town hall appearances around America?
No, he's not going to
talking about the virtues
of
data centers?
But I think at some point he could offer a degree of comfort about the economics of a data center build out in your backyard. I think clearly he's the one person that could do that. I'm not saying he's going out around the country. No, it's crazy. But he can comfort.
No, I know you're not saying that, but I'm suggesting that that's far different from talking to a bunch of analysts, singing the virtues to the analyst community in Wall Street of data centers. That's talking your own book. What do you think he's going to say?
I think that tomorrow night on the conference call, I'd like one analyst to ask him the question. I'd like him to give me what I expect will be a very confident and comforting answer that maybe offers some relief to the conversation that over the last several weeks has intensified.
At the end of the day,
Plain
the
and simple.
hyperscalers are going to spend $1 trillion this year and probably $1.6 trillion next year and probably $2 or $3 trillion in the next couple of years. They're not slowing spending. And we listened to the CEOs of all the hyperscalers, Andy Jassy in particular at Amazon, who has said he would spend even more if he could. And so therefore, that is not changing. And if you believe that, then you have to believe what we've talked about. The whole food chain will benefit. The data center builders, the grid manufacturers, the power companies, we don't have enough power. So all of that continues as long as we get the spend. The biggest risk is if we don't get the spend. But that's not what the companies are saying right now.
And the cost of capital doesn't rise significantly.
Josh,
that's
real quick, make your point because I got to take a break.
I'm with Stephanie on this. All of us on the desk have been around a long time. They did the same thing with the cell phone towers. It was a huge political backlash. It was in every district, every state. There was for, there was against. In the end, there was federal legislation that stopped the madness. We built the cell phone towers. People didn't grow a third ear on the back of their head, and life went on. I don't think that you'll really be able to stop the spending that we're expecting. You might just have to move the venue.
All right, let's do this. Let's take a break. We'll come back on the other side with several moves. A couple from Steph. We got one from Carrie. We'll document them next.
We're back on Halftime Report. I am Frank Holland with the CNBC News Update. A federal judge has rejected Ghislaine Maxwell's latest attempt to overturn her 2021 sex trafficking conviction and 20-year prison sentence. Judge Paul Engelmeyer called her claims meritless, saying newly released Epstein documents either incriminate Maxwell or support the rulings that she's challenging. Brazil's data protection regulator has fined TikTok parent company ByteDance nearly $30 million over alleged failures to protect the personal data of minors. Officials say the platform collected information without adequate safeguards. TikTok must delete data gathered illegally and can appeal within 10 days. And 2 astronauts are spacewalking outside the International Space Station today to finish replacing a space-to-ground communications antenna. Anil Menon of NASA and European Space Agency astronaut Sophie Adnot removed the failed unit last week, but they didn't have time to replace it. Today's spacewalk is expected to last 6.5 hours. Scott, back over to you.
All right, Frank, appreciate that. Thank you. We do have some committee moves to hit, and we begin with Carrie. You bought Vertex. And when you buy anything in the healthcare arena,
yes,
we sit up and we take notice. So why this? Why now?
The main reason now is that the stock has basically de-risked the concept that there will be competition in cystic fibrosis. So they own the cystic fibrosis market. They created the drugs that have worked to keep people alive who used to die very young. You can live a full life with CF because of Vertex. And there was a competitor was doing a phase 2, Sienna. The drug failed in the phase 2. That released, I think, an awful lot of pessimism. Gone. It's now gone. And so Vertex has sort of free selling. So what else? They do $13 billion a year in CF, very highly profitable drugs. Then they have drugs for it's a pain medication. It's not an opioid, non-addictive in the traditional sense. And we think, even though it's had a slower start, it can be a multi-billion-dollar drug. Then you've got drugs in renal and autoimmune disease, the Holy Grail, which is in insulin, in a drug for diabetes that can really solve the problems of daily insulin requirement. We see 15% roughly earnings growth over the next 10 years, and the stock at that level, at a 20 multiple, can double for us.
That's a chart, isn't it? 5 years. Put that guy's back up, please.
Yeah.
Don't pull it away. There it is. Thanks. 5 years, 175%. Right? That's a move. Record high.
Yeah.
Last Friday.
Correct.
You highlighted this name as part of a few of the names that you said you like the best of all. You said it's Incyte, it's Vertex, it's Amgen, Lilly. Tell me more. Why did you include Vertex?
Just so eloquently stated, Carrie, as usual.
Thank you.
But they have dominated the cystic fibrosis market. They have clearly established themselves as the singular destination in terms of treatment. They also have improved their balance sheet dramatically from where they were in 2024.
Correct.
So their free cash flow, Scott, in 2024 goes negative. Their free cash flow is back to levels that we have seen in prior years and approaching all-time high. So the revenue growth rate is remarkably strong. Everything you've described, the market share, that's anchored. It's a momentum stock as well.
So it's a little bit of a tease as well to Josh's best stocks, which is coming up in the same space. Joe has a move in the same sector, but we're going to hold those till we get there. So bear with us. All right, Stephanie Link, you have a couple of moves. So you trimmed Palo Alto.
Yeah.
Why did you do that?
This is no reflection whatsoever on fundamentals. This is a stock that is up 145% from February 24th's low levels, and I just wanted to take some profits. It actually, because it's rallied so much, Scott, it's become a huge position in my portfolio.
How about almost 150% in 6 months?
Yeah, I mean, but look, the fundamentals are strong. They have 10% of market share in a $300 billion total addressable market. You know how I feel about cybersecurity. I just needed to take a little bit off, and it helped to fund the new position that I added to.
Joe, you own it?
I do. Coming up on earnings, I think it's next week for Palo Alto, and it's CrowdStrike is today or tomorrow?
I think it's tomorrow.
Okay, I know CrowdStrike is first in the lineage. I think both of those names have had a little bit of a pullback. If you could show CrowdStrike here over the last 3 months, you'll just see a modest retreat back into what I think are the supportive moving averages. I think it's a great spot to actually get ownership, and I think you're going to hear a consistent story that we've heard from cybersecurity about CTOs not limiting their budgeting and their spend in the direction of enterprise security. I think that's going to be the dominant theme.
This just became 6%.
Yeah, no, I get it.
That's a big.
Okay.
That's a big.
And you can include Fortinet there as one of the names you want to own as well.
So you have you mentioned funding a new buy.
Yeah.
That's EQT.
Yeah.
Why?
I actually have never owned it, so we just talked.
Joe owns it, so tell
Well,
tell us
it's flat-
why you bought it.
Well, it's flat on the year and it trades at 5.8 times EBITDA, so it's super duper cheap and it's lagged. But we just talked about the AI infrastructure and how you need the food chain, and power is part of it, and we're short power. And I think natural gas is going to be the winner. We just don't have enough pipelines, but we have enough natural gas, and these guys are the largest U.S. natural gas producer. They have size and they have scale, high quality assets, and a kind of a disciplined operating model, low cost, and just the leader. And if anytime I can get a leader that's lagged, I kind of like that.
Natural gas prices are down 25% year to date, and EQT has had relative outperformance to that. Why? The bull scenario is exactly what you said. They are the #1 natural gas producer in the Appalachia, which is close to Virginia. Virginia is the dominant data center geographic region in this country right now. They are providing the power via the natural gas. That's the bull story. The bull story is winning out for this company despite soft natural gas prices. If natural gas prices get going into the winter, I think this is a $70 stock.
Wow. Okay, getting a little bit of a lift here. We'll take a break. I told you Josh has best stocks in the market. The focus is in the healthcare space, so we've teased that. We'll give you the names that he is looking at and highlight Joe's move there as well when we come back. We're back. It's time for Josh Brown's best stocks in the market. Spotlight on Merck and Amgen. Give us more.
Yeah, let's do it. I want to start by saying the best stocks in the market list is loaded with healthcare right now, and a ton of biotech in particular. And I know we've been talking about a bunch of names like Incyte, et cetera. We've talked about Merck and Amgen before, so this is sort of an update. Everyone saw the Moderna news on the phase 3 trial. Unbelievable, almost miraculous result. And obviously most of the gains went to Moderna, up 175%, but Merck went up 10%. The stock is now up 15% from our July 6th write-up. It's up 30% year to date, closed at an all-time high this week, 154. What's happening here is a re-rate of the entire pipeline. Investors are thinking bigger about the other things Merck has besides Keytruda. We have a breakaway gap here technically out of that 137 area. That was a 1 year long base. This is the kind of gap that doesn't fill quickly because institutions are buying the urgency, not the price. So the gap is held. The stock is extended up here into the 150s. You got a rising 50-day at 128, 200-day all the way down at 115, but both are rising. The one negative for new buyers here, elevated RSI. 77 RSI is a very overbought stock, but on breakaway gaps in particular, stocks can stay overbought for a long time. So if you're in this name, I think you're using 145, the top of the gap, as your reference on a closing basis. If you're a longer-term investor, use that 50-day at 128 and trail it. You want to do Amgen real quick?
Real quick, because I want to kick it on the desk too.
All right, you got 6 growth drivers underlying Amgen's future. 70% of product sales, already growing 26%. A group of products. Management raised full-year guidance. We like that. RSI 73 also elevated. The whole sector is on fire. But the old resistance, 390 to 400, back from February and March, that is now your pivot point as a trader. A weekly closing low below 390, that's when you might want to change your mind here and do something else. So long as this stock stays above, I think you want to be long. I like both. They've both been on the list all year, and they both remain.
Kara?
Yeah, I just would say in support of the biotech trade that this is finally the beginning of when we see the AI benefits to pharmaceutical development and the creation of drugs that can target very, very specific sites in the body that treat particular conditions and find the patient population for whom that will serve. Amgen has, as Josh pointed out, many irons in the fire. Maritel, the diet drug, the GLP-1, GLP-2 drug, is at the top of people's list. But it's also a company that has deep, deep roots in oncology, in hematology, and immunology. So there's a lot of potential there. But this is a sector, if you pulled up the BTK, that has been on a streak this year and should continue because the numbers are coming out better. There have been positive clinical trials. We think this can continue and should continue over the next few years.
Joe, Amgen?
Amgen.
Right? And you sold Merck recently.
Yes. So it's Amgen, it's Gilead, it's Vertex. Those are 3 giants that we hold in Jyoti. It's interesting, and look, this could lead to a big debate. I totally support what Josh is saying in terms of owning Merck. I've owned Merck personally and in the ETF, but the problem and the reason why I was removed from the ETF was on the quality factor. Believe it or not, Merck fails in that regard. The valuation is a little bit extreme. The revenue growth is not there to support it. I love the biotech trade.
Well, you bought more of the XBI. That's your move.
Absolutely, I did. I began building a position last year at 101 for the XBI. I have been building the position higher and higher. Back in June, I shaved a little bit of the position. I'm now positioning for a break above the February of 2021. If you could show a 5-year chart, you'll see the all-time intraday high at 174.79. A lot of people always ask, why XBI and not IBB? IBB is market cap weighted, and you get your Amgen, your Gilead, your Vertex there, so I don't need to travel in that vehicle. I'm going to be in the XBI. Keep in mind, XBI, a little more high beta, more volatility, exposed to the biotech trade.
All right, love all that. Thank you, guys. Mike Santoli, he's next with his midday word. All right, we're back. Senior markets commentator and overtime co-anchor Mike Santoli here at Post 9 for his midday word. Here we go.
Yeah.
About to get interesting, huh?
And the market is it's really trying to do as little as possible, just stay right there between the lines until we get both PCE and NVIDIA, I think. I heard the discussion about what the tendencies have been with NVIDIA's move, and it hasn't really been a massive swing factor for the whole market and all the rest. Maybe, valuation is compressed, expectations are low enough, and the AI skepticism story seems to be a little bit saturated right now. Maybe you have a little bit of a window. What I find most interesting is every single day we find a way to kind of stay almost flat. You still have crazy stuff happening, like Micron's trading in the $30, $40 range today on no news, 3-4% range just because the market's open. But everything else is very much kind of under control. We've stayed above the prior high of this trading range. And so I think until it changes, you're not really drawing any big conclusions.
Marvell's good for 5.25%.
Yeah,
So
right. Look, semis did give back a lot of their bounce, but now they're trying to kind of firm up again.
I'll see you at 3. Right. Mike Santoli. Oliver Rennick, he's next. Options action coming up. some options action. Oliver Rennick at the CBOE in Chicago. What do you see?
Hey, Scott, a lot of flip-flopping in the options on treasuries right now, and it's not hard to see why. The chart of the 10-year yield has been a game of 15 basis point ping pong for weeks, and the TLT is now back to its highest level it's been all month. Options traders were mostly buying calls on TLT all the way down this summer, and today it looks like they're reloading. They're buying upside calls in the fund with almost 170,000 calls likely bought versus under 40,000 puts. And the biggest trade was a bullish call spread buyer who spent about $1 million on 85 strike calls expiring in November and sold $375,000 of 90 strike calls against it. It's a trade looking for the long-term bond fund to at least get back to levels last seen the first week of July. And by the way, related, in Bitcoin fund IBIT today, calls are still outpacing puts, and in GLD, with today's pullback, calls are almost 5 times puts right now, Scott.
Okay, Oliver, good stuff. Thank you. See you at 3 o'clock. Oliver Rennick coming up. An earnings mover tracking for its worst day ever. Steph owns it, which means we need to hear from her coming up. Welcome back. Dick's Sporting Goods down, wow, almost 30%. We said going in that this space has been challenged, to say the least, and you look at almost any name around the either athletic footwear, sporting goods. What happened here?
Well, it was all Foot Locker. So actually, Dick's itself posted pretty good results, but Foot Locker was a disaster. They had to spend 65% more in SG&A for integration. They've got product issues. They've got legacy stuff that nobody wants. Same-store sales came in at -3.6. We were thinking maybe -1. And they lowered guidance. Gross margins, oh, by the way, fell 200 basis points. So Foot Locker is a mess. Foot Locker is 30% of total revenues to Dick's. Flip side, Dick's actually posted a 4.9% same-store sales number. Transactions up 1.3%. Ticket up 3.6%. And they maintain guidance in Dick's. So they're doing fine in Dick's. I like that piece of it. Obviously, I thought that the Foot Locker integration was going to be better than expected, but now this is pushed out. And I honestly don't have a timeline for the recovery.
Look, you think about, look at Nike. I mean, there's a lot of things down in sympathy, I think, today. Look at Nike.
Oh, everything.
Remember on after its earnings got crushed almost to the same degree, I feel like.
I think, but for me, though, I thought, well, first and foremost, this is a phenomenal management team. They really are very, very good. The Dick's side of it. And I think they have done a really good job with the Dick's side of it. And I really thought that they were going to be able to bring Foot Locker along. And in the last 2 quarters, if you remember, they actually improved same-store sales better than expected at Foot Locker. So it just fell off a cliff. It's a macro call, but it's also an integration call. And I don't know what I'm going to do, Scott. I think 30% down is way overdone. But this is going to take a long time to fix. And I don't want like another Target. It took me a long time to get paid for Target. I just don't know if I want to do that again.
All right, you'll update us if you do anything with that name. That's Stephanie Linker, of course. We'll take a break. We'll come back with finals. We'll do finals. Josh Brown, please kick us off.
I added to Delta. This stock has pulled back right into the low 80s where it's found support before. I still think travel is the best part of consumer spending, and that will not change between now and year end.
Care.
Thermo Fisher, it's having a run up 43% this year, but it's the leader in high specialized equipment in healthcare.
Target.
Interactive Brokers.
See you at 3.
And welcome to the Exchange, everybody. I am Brian, once again in for Kelly. We have got a big hour ahead. Stocks higher across the board. The NASDAQ on pace for its best day in nearly 2 weeks. Tech outperforming and chips rebounding. Marvell, AMD, NVIDIA, all among the top performers. NVIDIA, by the way, on pace to snap a 7-day losing streak, all ahead of its big earnings. tomorrow night. That's sending yields down. That's also giving tech a leg up today. We're going to bring you the results of the 2-year auction in a few minutes. That'll give you a window into the bond market. The dollar is down, but gold and Bitcoin, they are higher again. In fact, Bitcoin back above the 80,000 mark earlier today for the first time in 3 months. A little bit below that right now, but earlier was above it. Gold on pace for its biggest monthly gain since 1999. Somebody call Prince. But don't worry, Katie Stockton's going to give you her take on all of that and more. And oil. We got to look at oil. Got some breaking news. Oil is down about 3.5% right now. The Abu Dhabi contract, which is the third biggest contract really in the world, third or fourth, whatever you want to do it, is down 8%. Here's why. Moments ago, the countries of Iran and the countries of Oman, who together share a lot of the border around the Strait of Hormuz, announcing they have reached a tentative deal to establish more clear and open transit around the Strait of Hormuz. They both put out a statement in English. I'm going to read it. I'll apologize. The ministers discussed a phased framework that could provide a practical and viable basis for moving forward regarding the Strait of Hormuz. It includes the creation of what they call a temporary joint corridor, information exchange, traffic management, and provision of relevant maritime and security services. We don't exactly know what any of that means, but the reality is this: Oman and Iran coming together saying they're trying to build some kind of framework. I'm just going to wildly speculate and guess that that might include some request for money or some kind of a toll through there. There is no also guarantee the U.S. is going to buy into this, nor would Kuwait or Qatar or Bahrain or Iraq or Saudi Arabia or the UAE, any country that actually transits oil through that strait. They may say no thanks. But the reality is that this announcement of a framework of a deal is impacting oil. Crude oil down 4% right now. And that UAE contract, known as Murban, you could see it there, is down 8%. We're going to get more with Amrita Sin, more with Halima Croft on Power Lunch. All this is happening real time. Welcome to Live TV. You also have this: billionaire investor Stan Druckenmiller, who, by the way, is the former boss of both Treasury Secretary Scott Bessent and Fed Chair Kevin Warsh. Not bad. Druckenmiller says those two should do things different. We'll get to that momentarily. Why don't we start right there? Kicking off your hour, Nancy Tengler, CEO of Laffer Tengler Investments. Nancy, I wanted to start entirely with Druckenmiller and Warsh, whatever, but I do want to get your take on this oil announcement. I know you're not some oil guru, so I'm not going to go into the details about the Hormuz Strait, but do you have a take on what might happen to equities or our markets overall if the price of oil were to continue to move down?
Yeah, Brian, I think it's going to be bullish in general. And I think the moves that we're seeing in Bitcoin, the risk on assets are at least a leading indicator of what the market is anticipating. Earnings growth is kind of old news now. We had a great earnings season. Oil is the next big inflation buster. And so I think this would be very optimistic for equities as we go into the fall and the pre-midterm period.
Yeah, I mean, and there's no one. Listen, I want to be clear. Like, we have the news and the statement from Oman and Iran. I mean, the United States may have a different point of view. All the countries I referenced may have a different point of view. Things could reheat up next hour, tomorrow, next week. Who knows? We know it's been a volatile 6 months. But to your point, if some kind of lasting peace or whatever were to be accomplished and oil went back down to 70, 65, whatever number it is, you think that's just a net add for the equity market?
I do. I mean, we saw the impact when oil prices receded in the previous month. We saw what it did to inflation, and we had a negative print, and then we had a flat print. So I think it will get resolved. This has been a lot harder on the economies in the Middle East, obviously Iran, but all the surrounding economies. So I think it will get resolved. How long it will last? That's a different question for the history books. Historically, we've not seen these agreements last very long, but we've debilitated the Iranian military, and we've got the pressure that came from Scott Bessent yesterday, I thought was interesting. It was a shot across the bow saying, you know, we're going to cut off trade. That's not going to work for economies that are already struggling.
You know what? In fact, sit right there, Nancy, because we're going to get more on bonds and Treasury. That's actually how we wanted to lead the show. We had that little we had the breaking news on Oman and Iran, but we do have 2-year notes in the bond market that are up for auction right now. Let's get the results of that auction and maybe his take on the bond market. That is Rick Santelli in Chicago. Rick.
Hi, Sully. Yes, indeed. This was the first of a 3-leg offering from the U.S. Treasury, totaling $183 billion. This leg, 2-year notes, $69 billion. They went off at top of the hour at a yield of 4.204. The one issued market was 4.208. So it tailed in a small way. Most of the metrics were at or slightly better than the 10 auction average, so my grade was C+. 4.204 the yield. What's interesting here is our auction last month at 4.315 yield was the highest since DEES of 25. Of course, this reverses it. And being the first leg of $183 billion, we still have 5-year and 7-year left. In my opinion, the 5-year, the auction tomorrow will be the most important of all 3 because 5-year is right at the epicenter of much corporate financing. In terms of yields today, I continue to point to the fact that we can all debate whether Treasury Secretary Bessent's policy is right with respect to his end of July buyback announcement and subsequent increases in potential tally there. But in the end, if you're just a market watcher, if all you're looking at are the charts from the end of July to today, I really don't see that the market pushed back in any direction on any of those issues other than some intraday volatility, no lasting impact. Now, does that mean it's not an important thing to discuss? Oh, of course not. It is important. Maybe it's not good policy. That seems to be what the op-ed is talking about. When it comes to debt and deficits, our government is not doing a good job. However, the announcement itself at the end of July did not, in my opinion, have any lasting impact. Didn't improve things, didn't deteriorate issues. It seems to me it's hard to pick out anything going different at the end of July than over the last several months in long-dated Treasury yields, especially if you concentrate on the 10-year.
And the 5-year and that auction tomorrow that you will bring us, Rick Santelli. Thank you very much. All right, Nancy Tengler, going back to you. It sounds like you would agree. I think you would agree with Rick Santelli that, this was an announcement from Treasury, but the bond market kind of shrugged it off.
Yeah, I do think so. I mean, we have something else going on here besides that announcement, and that's a market that's testing the Fed chairman. And that's typical. That's not unique to Chairman Warsh. I actually think the changes that are being made by the Fed are positive, net positive. Traders have a memory of about 20 minutes, but the rest of us that have lived through these situations in the past have worked with a different Fed regime where we didn't get spoon-fed guidance. And then to the question of Secretary Bessent, we had Operation Twist in 2011 after the debt downgrade, pretty much the same strategy, and it did flatten the yield curve. We'll see if that works here with the other caveat being that we've got a new Fed chairman. But I think it's much ado about nothing. Yeah. It was a statement, and I don't think it's going to tank the bond market or the equity market.
What about Friday is when Kevin Warsh in Jackson Hole will give his first major policy speech as the new Fed chair. I know we've heard from him at 2 meetings, but this is going to be like the first big speech. Does that have the possibility and optionality of moving the market?
I mean, it certainly does, Brian, but I don't think we're going to get much out of him. I think this is the less is more Fed chairman. He's going to let his task forces work and do their due diligence and job. And he is really trying to teach the market that he's not going to be giving guidance at every meeting and that the Fed is going to be looking at the data. Now, we've heard that for years, but it hasn't necessarily happened. And they're going to be looking forward at other indicators. So I think the bond market's going to get used to it. We really didn't see a yield tantrum from the bond market. So I think, this range is fine. We had 5, 6, 7% 10-year during the 90s, and we had robust stock price performance. So it depends on what's driving it. And I think we have the economy is super strong, and we're seeing the manufacturing numbers continue to deliver. I think this is a pretty robust period to be focused on stocks.
All right, robust period. Certainly today it is. Big rebound back for tech. Nancy Tengler of Laffer Investments. Really appreciate it, Nancy. Have a great day.
Thank you.
All right, so let's get back now to that breaking news at the top of the hour. The Omani Foreign Ministry saying, quote, I am hopeful we soon will announce a temporary corridor for the Strait of Hormuz and practical arrangements to restore safe navigation. Crude oil was down going into the statement. It lost about 1% more. So not a huge move for the price of oil, but it is down about 3.5%. The Murban contract to UAE down 8% right now. Let's bring in our friend Amrita Sen of Energy Aspects by phone. And Amrita, listen, I know this is literally happening 10 minutes ago, so we're kind of putting you on the spot. Thanks for joining us. Your take on this, I guess, announcement of an announcement.
I would say, Brian, very, very skeptical because we've seen this before. Remember, a few weeks ago, there was a lot of chatter around some kind of framework between Iran and Oman, and nothing came out of it. If you read the statement, there are no specifics. Of course, they talk about we need to come up with a solution for Hormuz. That is absolutely something everybody wants, but I really wouldn't read too much into it. Look, we've been on this downward kind of pressure for prices because some in the market were expecting a much stronger stance from the U.S. with regards to the kind of economic pressures that they've been talking about, but the sanctions yesterday didn't really come to anything. That's why we are under pressure. And of course, you know, when you've got algorithmic trading and just generally machines read headlines like that and they sell. But trust me, on a fundamental basis, none of our clients we are speaking to will take this seriously as meaning flows are about to resume without, you know, attacks. Let's be clear, there was an attack overnight today as well.
Yeah, there was. In fact, I think it was an Omani ship that was hit or almost hit. So maybe they're forced into a deal. So what you're saying is, Amrita, that basically the move we're seeing right now in crude oil is not some fundamental optimism among human beings. It's like, okay, they're going to get a deal. It's a computer or AI reading this announcement and extracting some sort of positive tone, and that tells it to basically just sell the oil contract.
Yeah, absolutely. And I think this is something we've seen because liquidity has really been thin in the oil market pretty much since, you know, a month after the crisis, because it has been very difficult to trade. It's very headline driven because, again, you know, you get tweets all the time, and it's been hard for traders to hold on to positions, whether you're bullish or bearish, right? If anything, that's why you've seen product prices, and we don't talk about it enough. We talk about crude all the time. Look at gasoline, look at diesel. I mean, this is the first time in the history of the market that the diesel crack is higher than the flat price of crude. Heating oil was above $100 crack, which means the flat price is like $190, $200. Ultimately, that's what you and I pay for, right? That's where the tightness has shown up. But crude, because you don't have the liquidity these days, is